Namaskar friends, welcome to the channel JIV and CIV Made Simple. If you are preparing for IIBF Certified Treasury Professional Examination and if you are looking for one video where all the important MCQs are covered, whether it is numerical, whether it is theoretical, then you are at the right place. Because in this video, we are going to cover top 150 MCQs, starting with the numerical one and then after the theoretical one, covering the entire syllabus which has appeared in the previous year, right? So you try to solve the question on your own, especially numerical part, as it account for almost 40% of the question paper, and try to see the explanation after your solving. If you want any kinds of study material in the form of PDF, downloadable, printable, then you can WhatsApp me on this number shown on the screen. So let's get started. Watch the video till the end and you will feel super confident attempting the examination. But on a particular date, it maintained only 540 crore. The prevailing bank rate they have given 7%. Now, if the RBI penalty for non-compliance is how much penalty is there? Bank rate plus 3% per annum. That is the penalty that RBI charges. So the question is, what is the penalty amount for a day's default on the shortfall? That's the question. Very good question it is. Let me show you the option. Option A says that interest at 7% for a day on 60 crore. Option B says that interest at 10% for a day on 600 crore. Option C says that interest at 10% for a day on 60 crore. And option D says that interest at 7% for a day on 550 crore. So let me show you the entire question in a single slide. So this is the question. So friends, in the question, as you can see, required CRR have given, right? First of all, what we will be interested in finding the shortfall. Right? What is the shortfall in CRR? Very simple. You see how much is the required minus how much is the maintained. Right, so this difference will be the shortfall. As you can see here, required is 600 crore. Right, you can see clearly that required is 600 crore and they have maintained only 540 crore. How much is the shortfall? Obviously, there is a shortfall. So 600 minus 540. So this will give you 60 crore. So that is the shortfall, right? Think that you were supposed to keep 600 crore but had only 540 crore. So you are short by 60 crore, isn't it? Okay. Now they are asking to calculate the penalty rate. They have mentioned clearly that penalty is bank rate plus 3% per annum, and bank rate they have also given 7%. I think this is the simplest question possible. See, don't get frightened by seeing the lengthy question. No. Everything is given in the question. Just go through each and everything minutely. So what is the penalty rate? What would be the penalty rate? It is very simple. You first write the base rate, right? To find the penalty rate, what you have to do? First of all, what you do, right? You write the base rate here. Okay. So it is base rate plus how much? 3% extra. Right, clearly they have written base rate plus 3%. So 7% base rate plus 3%, which is extra. So total become penalty rate become 10%. So that is your penalty rate 10% per annum. Right, this is the penalty rate per annum. Now one concept is that this particular penalty apply only on the shortfall and the period for the default. Please understand. Till when this penalty will apply? See, two things are very, very important. First of all, it will apply on the shortfall only. And second thing is that it will apply for a period of default. Can you tell me what is the period of default? Can you please tell me what is the period of default? It is clearly written for a day default. So means what? Single day, right? So penalty will apply on the shortfall, and that too, the period of default, here the period of default they have mentioned is 1 day. So can you calculate what is the 1 day penalty? Very, very simple. The rate they have given you, 10% they have given, isn't it? 10% is the annual rate, and they have to calculate the penalty for a single day. How to go about calculating the penalty for a single day? Very simple. Just apply the formula, right? Penalty is 10% of what? 10% of obviously the shortfall. Shortfall is how much? 60 crore. So just take 10% of 60 crore. And since this will give you the annual penalty, but you 10% of 60, right? So what would that be? What would be the 10% of 60? Right, very simple. It is nothing but 6, okay? And since we have to calculate it over 1 day, so we'll multiply it over 1 upon 365. Okay, this is a unitary method, basic unitary method, which you can rely on, right? Now friends, now just apply the formula, right? So it will be how much? 6 crore divided by 365. So approximately if you get the value, it will be 1,64,384, or we can say 1.65 lakh, right? For that day. So if you look at the option that we have, so option number A says that interest C 7% for on 60 crore. What option number A is saying? See, this is the wrong rate, right? Why? Because penalty rate is bank rate plus 3%, so 7% is wrong. Option number B say interest at 10% for a day on 600 crore. So again it is wrong amount. Why? Because penalty is charged only on the shortfall, not on the entire amount, right? That is the point. What about option C? Option C is yes, correct, right? Option D is also wrong. Why? Because they're saying interest is 7%. Again, this is wrong. So friends, like imagine you promise to keep 600 rupees in the bank locker for safety, but you keep only rupees 540. Just I am giving you one example to understand it more clearly. Imagine that you promise to that you will keep 600 rupees in a locker, but you keep only 540 rupees. So the regulator, they charge a penalty like a late fee, and that fee is charged only when you missed it. Only what you missed, that is the 60 rupees, right? That penalty will be charged on 60 rupees only. So you don't pay the fee on the whole locker amount, rather you pay only on what you missed. So remember what we learned from this question. The key learning from this question is that let me write down the basic learning. Please note it down. That suppose if they ask you to calculate the penalty, right? Just remember the formula. Whatever is the bank rate, just let me erase it. Yes. So if they ask you to calculate the penalty, what you need to do? Just write the bank rate. Please note down the formula. Just write the bank rate plus 3%. So it will be mentioned in the question, right? And then multiply it by shortfall, which means how much shortfall it is in terms of amount, and multiply it by time, right? And one more thing is that how to find the shortfall. So to find the shortfall, the formula is very simple. You write the required and you subtract the maintain. Required minus maintain, that is the shortfall, right? And what is the time here? Time is the period of default, right? Time is the period of default. How to find the time? Very simple. Just divide days by 365. That will give you the time. I hope this is clear, crystal clear now. Now friends, let's see the next question. Again, this is a numerical based question. Please go through this question once more. So the question says that a zero coupon bond is there, right? It has a face value, they have given 2000 rupees. So first of all, zero coupon bond, face value they have given $2000, I think, not rupees, $2000. And it is maturing in 8 years. Fine. Now, one more point they have given that if the market required yield, so yield of market is 7.4% per annum and compounded semi-annually. This one is very important. Compounding is to be done semi-annually, right? Now friends, question is asking you what is the closest approximate price of this bond. Very good question, right? Please see the key terms which I mentioned here, right? Now options are, options, let me show you 1134.80, 1105.10, these are the 4 options. So first of all, try to solve it on your own. Let me explain. So first of all, do you know the meaning of zero coupon bond? Do you know when I say zero coupon bond, what does it mean? Let me explain. So friends, zero coupon bond means here, but it will pay nothing. It will pay nothing till maturity and then pay the face value of $2000. How much is $2000 at the year end, right? At the year end, right? So see, let me show you the cash flow, how it will look like. So initially you have invested how much? $2000. So this is your investment. $2000 invested. First year 0, second year 0, third year 0, till 8th year you will get 0, and then till the 7th year, and the last year you will get this $2000, whatever you have invested, isn't it? Right, but they are offered at a discount. This will not exactly cost you $2000. It will cost you a little bit less. Fine. Now that is the point. That is about the zero coupon bond. Okay. So basically, it is not offered at $2000. They will offer you certain discount. You will buy this at certain discount, and this will be redeemed at the face value. Remember, zero coupon bond are bought at the discount value and redeemed at the face value. Right. Now we have to find the price. What the question is asking us to find? Calculate the closest approximate price of this bond. That is what question is asking you, right? So now, how to go about finding the price? Do you know the formula? See, the price is very simple. Let me show you the formula here. Let me show you the formula. See, basically what we need to do, we have to discount it. We have to discount the price. How to go about discounting it? Very simple. See, this is your cash inflow, $2000, and just you discount it to the today's date. How to go about discounting? Very simple. So we are trying to find the present value, which is nothing but future value, divided by 1 plus r whole to the power. I think you are familiar with this formula, right? Okay, friends. Now, first of all, we must understand one thing they have written is that, in the question they have mentioned clearly that it is to be compounded semi-annually, right? It is to be compounded semi-annually. So what is R? What is R will be, sometimes I or R. So the IR will be, capital R divided by 2. Isn't it? Because in a particular year there are 2 semi-annual. And what is the capital R they have given? Capital R they have given is 7.4. So it will be how much? 7.4 divided by 2. That would be 3.7%. Right. So this is our R, small r, right? Interest rate. And what about N? Can you tell me what about N? See, capital. So this N will be capital N multiplied by 2. So what is N they have mentioned? 8 years, right? And 8 years. So 8 multiplied by 2. So you can simply think like this. In a particular year, there are two frequency, right? Two compounding frequency. So in 8 years, there will be 60 compounding frequency. I hope it is crystal clear right now. Isn't it? Now let's discount the future value of $2,000 to the present terms. So what will be the number would look like? Look at it here. So 2000 divided by 1.037 to the power 60. Isn't it? So this will, if you calculate it using the calculator, the closest option you will get 111.8.33, which is near about 111.8.33. Is it clear? Right. So that is how we find the closest approximate price of a bond. Right. So friends, remember, think of the bond like a promise. Someone promised to pay you $2,000 after 8 years. If the people require 7.4% return, you will pay less today for that promise, right? How much you are paying? You are just paying 111,118.33. You are just paying that, right? So we calculated what that less amount is. Again, I am repeating. You can think of a bond like a promise, right? Someone promised to pay you $2,000. Suppose I promise to pay you $2,000 after 8 years, right? After 8 years, I promise that I will pay you $2,000. So, and how much return I require? I require is 7.4%, obviously, right? So obviously you will pay less today for that promise. The higher the required return, the lesser you pay now. Suppose instead of 7.4, it goes to 8%. So this rate is increasing, right? So what will happen? The bond price will decrease, isn't it? The higher the required return, the less you pay now. That is what. How do we calculate it? We calculated what that less amount is, and that less amount is 118.33. So remember, the formula that you need to remember is this formula, right? To compute the present value of a euro coupon bond. Please let me know if this concept is clear or not. Friends, if you are looking for study material for CTP examination, we have fully fledged coverage of study material in forms of PDF, videos, mock test, as well as such kind of previous year questions. You can WhatsApp me on this particular number to get detail related to the CTP examination. Many aspirants have cracked the paper using our content. You can also crack in the simplest way possible. Now friends, let's switch our focus to the next question that we have. This is the third question, right? I request you to please try to solve it on your own first and then see the explanation. This will help you to understand the concept. So the question is saying that there is a portfolio, right? And it is generating an annual return of 12%, right? Risk-free rate they have given 5.5%. Standard deviation of the portfolio return they have given 4.5%. You have been asked to calculate the Sharpe ratio. Exactly this question appeared in the examination. You have been asked to compute the Sharpe ratio, right? Very good question it is. So let me explain how to go about calculating the Sharpe ratio. First of all, you must understand what is the meaning of this term so-called Sharpe ratio. Let me explain it here. Let's understand the meaning of this term. You know it very well. It measures that how much extra return you earn for each unit of risk you take. Very, very important. Each unit of risk you are taking, how much extra return? Extra return is how much? Right. That is called the Sharpe ratio. Now let's plug in the number. Right. Now let's plug in the number. So friends, the formula of Sharpe ratio is very simple. Right. First of all, you write the portfolio return. Portfolio return minus risk-free rate divided by what? Standard deviation. Standard deviation. Now friends, let's plug in the formula, plug in the value that we have. So how much extra return you earn for each unit of risk that you take. Now in this case, as you can see, annual return they have given 12%. Risk-free rate they have given 5.5%. So it is very simple, right? Just plug in the formula. 12 minus 5.5 divided by 4.5. So how much would that be? I think 12 minus 5.5 will give you how much? 6.5 divided by 4.5. That will be 13 by 9. It will be approximately 1.44. Isn't it? 1.44 is the correct answer. Yes, option B is the correct one. Yeah, this one is the correct one. 1.44. Right. So friends, you can think of it like this. Let me explain a way to think about it. Suppose that you invest in a portfolio. Right. It gives you extra 6.5% return. You can see now, risk-free rate is 5.5. What is the meaning of risk-free rate? Suppose you invest in a government bond. And government bond has nothing to, it is the safest bond. That is, there is no risk in there. So the government bond yield will be 5.5, and you are investing in a portfolio where return they are given is 12%. So how much extra return they are generating? Tell me. How much extra return they are generating? Obviously, nothing but 12 minus 5.5, which is equal to 6.5%. The 6.5% extra return they are generating, right, above the safe option. But yes, you took 4.5 unit of risk. What does the standard deviation indicate? A standard deviation is indicating that how much risk you are taking. Think about it. For 4.5 unit of risk you are taking, you are getting 6.5% return. Now the question is, for the 1 unit of risk you are taking, how much return it is generating? That's called the Sharpe ratio. This is the simplest way one can understand. Think about it like this. Unitary method. You know about unitary method? I think you know it very well. See, what I am telling you, that for 4.5 unit of risk that you are taking, it is generating you how much return? 6.5% return. So for 1 unit of risk that you are taking, how much return is being generated? Just divide by that. It will be nothing but 13 by 9. It will be how much? 1.44. That is the correct answer. So option number B is the correct one, right? So that is what Sharpe ratio tells you, that reward per unit of risk. Just remember this keyword. It tells you reward per unit of risk. See, this way we understand each and every concept. See, whenever I provide you a question, I explain you each and every part of it, right? So that you have a clear understanding of it. So better see, two things to remember here. Again I am repeating. Please remember this formula. Let me again show you the formula. Please note down this formula in your notebook or somewhere else. Please note it down. This is the super important formula. Portfolio return minus risk rate upon standard deviation. And second thing you need to remember is that higher the Sharpe ratio, base risk adjusted performance. So the question may ask you whether Sharpe ratio should be higher or lower. The answer is should be higher, right? Now friends, let's have a look at this part of the question. This is one of the most familiar question. Every time you ask in the examination, they are asking you to calculate the convexity of the bond. So now let's see how to go about calculating this question. Now friends, think about it. What data they have given? 7 years, 7% coupon bond. They are currently trading at $105.180. Suppose bond price increased to 106.50. Okay, it has increased to this much, and yield drop by 10 basis point. And bond price decreased to this much when the yield rises by 10 basis point. So what is the convexity of the bond? Very good question it is. Right, options they have given: 210.24, 305.50, 155.65, and D none of them. Very good question. So first of all, what is the meaning of convexity? Let me show you the formula. What is the formula that we use to compute the convexity? See, let me write it down the formula here. Just wait a minute. Yes. So if you want to compute the convexity, right? So first of all, you write a P plus, P minus 2 times P naught divided by P naught multiplied by delta y divided by 2. Right? So this is the formula that we use to compute the convexity. Now in this case, what is P1, what is P minus, what is P naught? Let's understand. So you can see, right? So friends, please understand, very, very important thing I'm telling you, that, see, price, P naught means what? P plus. What is the meaning of P plus? P plus means, price if the yield fall. Sorry. Yes, correct. Price if the yield fall. Okay, you know it very well that, price and yield are inversely proportional. I think you know it very well. Whenever yield will fall, price is bound to rise. Okay, so P plus means what? Price is rising. Okay, and when price will rise? When yield will fall. Okay, so what is the price when yield fall? It is nothing but P plus is how much? 106.50. Now what is P minus? P minus indicates, decrease in the price. No, sorry, decrement in the price. Obviously, when the yield will rise, price will decrease. And what is the decrease in the price? Okay, it decreases to 103.95. Okay, this is P minus. Okay, now you may ask me what is P naught? Yes, very good. I will answer it. So P naught is the current price. What is the current price? This is 105.180, isn't it? 105.180. That is your P naught. Okay, very good. So we know P plus, we know P minus, we know P naught. Now you have to just plug in the formula. Let me apply the formula here. And what is delta y? What is delta y? Yes, delta y is the change in the yield. And remember, this has to be written in terms of decimal. They have written, 10 basis point. Okay, so 10 basis point is what, it simply means 0.001, right? 0.001 in terms of decimal. Now plug in the number. So now we know what is our P plus, what is our P minus, what is our P naught, and what is our, delta y. Just plug in the number. So P plus will be how much? 106.50 plus P minus will be 103.95 minus 2 times P naught 105 plus 180. I request you to please solve the question on your own. And if you really think that this video is helping value to your preparation, please hit that like button. It will encourage me to make more such content. Now what is P naught here? P naught they have given 105.180. And what is delta Y they have given? Delta Y they have given 0.001 upon 2. So if you calculate it, you would get 210.24. That is your convexity, isn't it? So now if you look at the option, you can see directly that option number is the correct one, right? So other options are not matching the data, that's why they are wrong. I hope this is crystal clear right now. So friends, now the question is, how can you interpret this convexity? Now that we have calculated this convexity, what's the meaning of it? What is the physical interpretation of it? Let's have a look. You can think of the duration as the slope of the road. Suppose this is the road, right? Suppose this is the road. Okay, you know, it has a slope. So this slope is, you can think of the duration, right? You know, it tells you, this duration will tells you how steep price change or when the yield moves a little. You know it very well that when the yield will change, price will bound to change. And this slope tells you that what is the effect in price when the yield is changing. That is what this slope tells you. Now, if you look at the convexity, if we talk about the convexity, you know, convexity is like the curvature of the road, right? It is like the curvature of the road. It tells you how the slope itself changes. Yes, it tells you the rate of change of slope. Convexity tells you that rate of change of slope. See, slope tells you rate of change of price with respect to yield, and convexity tells you rate of change of slope. That's the difference, right? How the slope itself changes when the yield move further. And you know it very well. Suppose there is a bond which have high convexity. Suppose there is a bond which have high convexity. What happen, you know, when the rate fall down, bond price increase a bit more than the duration predicted. See, suppose that yield is decreasing. Duration is predicting that there will be, you know, bond price will rise just by 0.1. But you know what happened in reality? Convexity predicts that it will rise by 0.2%. Right? So that is the indication that, you know, this bond has high convexity. So what I am telling you, suppose there is a bond which have a high convexity. It tells you that when the rate fall down, bond price increase a bit more as compared to the duration, what duration predict. And when the rate rise, what will happen? When the rate will rise, you know what will happen? That, you know, price fall extra bit less than, right, duration predict. So that extra band is very, very helpful, right? The extra band is very, very helpful. It cushions bond price when the rate swing, isn't it? So you can think of it like a trampoline. Have you seen a trampoline? High convexity versus a flat plane, low convexity. Suppose this is the flat plane, right? It has a low convexity, and trampoline, you know, it is a high convexity. So the trampoline responds more smoothly and gives back more when you bounce up and down. So friends, please remember what you learned from this question. First of all, you must note down this convexity formula. This will surely help you, right? So this is the formula that we use to compute the convexity, first point. And you know, use observed price change for a small delta y change in the yield. And one more thing is that question may be asked whether convexity should be higher or it should be lower. Remember, convexity should be higher. Suppose our convexity increases, what does it indicate? It indicates that you have a better protection against the interest rate swing. So extra price gain when the rate fall and a smaller loss when the rate rise. That is, it's in practical. Remember, you know, duration tells you the slope, convexity tells you the band. If you like this style, please hit that like button. I will explain each and every concept in the lucid manner, as much lucid as possible, so that you can understand the layman terms. I hope this question is very clear to you. Now, have a look at the next one. So friends, as I told you already, 40% of the syllabus of the question paper is about the numerical. That's what we are focusing on right now. Now the question is asking you to compute the annualized yield on what? 91-day treasury bill. Face value they have given 100, currently trading at 98.80. And option they have given, these are the options, these are the 4 options. You have been asked to compute the annualized yield. Yes, very good. Again, I am telling you the formula. So I request you, please have a sheet of paper, right? A4 sheet of paper. Till now, we have discussed 3 formulas. You remember it? Please note it down. They will surely help you in the examination. Now there is the 4th formula, which I am telling you right now. So this is the formula that you need to remember to compute the annualized yield. That is what we are focusing on, right? Annualized yield of a bond. What is the formula? Face value minus purchase value upon purchase, sorry, just wait a minute, not purchase value, it's wrong. Face value minus purchase price upon purchase price multiplied by 100. Sorry. And one more thing is that, okay, since we are computing the yield, right? We are computing the yield. So what we need to do? 365 upon day to maturity multiplied by 100, right? So this is how we go about computing the annualized yield, right? Face value minus purchase price upon purchase price into 365 upon day to maturity 200. Now let's plug in the number. How much face value they have given? Face value they have given 100 rupees. You can see how much present price they have given 98.80. So it will be how much? 100 minus 98.80 divided by 98.80 multiplied by 365 divided by 90 multiplied by 100. Right. So that is the point. So this gives you the discount, right? If you look at the numerator here, if you just look at the numerator, this gives you what? This gives you the discount. So it is divide the discount by the purchase price. Okay. So divided by discount by purchase price. If you compute it using calculator, it will give you how much? 0.01214. This will give you, right? And if you compute it, this will give you how much? 4.01098 multiplied by 100. And if you compute finally, this will give you 4.87%, right? If you round it off, it will be 4.87%. Now friends, let's look at the option. I think nearby is 4.89. So this will be the correct answer. Okay. So friends, this is a very, very important formula that you need to remember. This is called treasury bill yield. Imagine that. Let me explain what is happening here. Imagine that you buy a coupon for how much? So you buy a coupon. You have invested how much? 98.80. You have invested today. Okay. And it will be redeemed at 100 rupees in 91 days. So after 91 days period, you will redeem it at 100 rupees. Is it clear? Please try to understand what this question is asking you to compute. I am explaining it. So after 90 days, 91 days, you will get 100 rupees. That is using redeeming. So basically, how much is the gain? That gain is how much? 1.20 rupees gain, isn't it? So that 1.20 rupees gain over the 91 days is your return. Right? This is what your return says. And if you want to compare it with annual return, we scale up to a year. Yes. So if you look at this particular formula, this thing is used for scaling up. Is that we are scaling it up? That's why our numerator is higher and denominator is lower. That's why we are scaling it up. Isn't it? Right? And that gives you roughly the annualized return. See, this is the very simplest thing to understand. Please try to understand. I have invested 98.90. After 91 days, I am getting 100 rupees. So how much is the return we are getting? Return is I am getting in terms of rupees is 1.20. Isn't it? This 1.20 I am getting over 91 days. Right? Okay, sorry. Yes, this 1.20 I am getting over 90.90 purchase price. Right? And just we have to scale it up. How to scale it up? Very simple. You just write the 365 in the numerator divided by 90 in the denominator. And by 108%. This will give you the yield. This is one of the most favorite question that we have asked every year. Right? Please understand this question, very, very important from a Jameson point of view. Now friends, let's have a look at the next question. So now we will solve a quick MCQ on delta hedging. Yes. So this concept is delta hedging. Let's understand it. So a risk manager at a bank, he has written or sold put option. He is totaling how much? I think it is 15 lakh. Right? 15 lakh dollar with a delta of how much? Minus 40%. How should the bank hedge its position using the underlying bond? That's the question. Very good question. Options are 4 options they have given you. Now friends, delta, what is the meaning of this delta? Delta tells you how much the option position changes for a small change in the underlying. Right? How much the option position change for a small change in the underlying. Let me explain. What is the formula for delta? So for the whole option position, if you compute the delta equivalent, it will be how much? It will be notional amount multiplied by delta. Isn't it? Let's plug in the value. How much is the delta equivalent they have given? You can see clearly they have given 15 lakh dollar. So just write 15 00 000 and multiplied by what? Multiplied by the delta amount. What is the delta value they have given? Minus 0.40. So it will be minus 0.40. Isn't it? So after calculate, this will give you minus 6 lakh. Right? So this is your delta equivalent. Now this minus 6 lakh, it means the option portfolio behaves like a being short. How much? $6 lakh of the underlying, because the delta is negative. To neutralize that, when I say neutralize that, what I mean to say, to make delta 0, that is when you will neutralize it. To neutralize that, we must take an opposite position of how much? We must take an opposite position of plus $6 lakh, right, in the underlying. That means, bank should buy bond worth $6 lakh. After buying, what will happen? This will get neutralized and finally our delta will be 0, right? If you look at the option that we have, so option A is saying sell bond worth 6 lakh. Correct? Incorrect. Yes, this is the correct one, right? See, combined with the $6 lakh from the written put, the net is 0. So a small move in the bond price won't cause a first order profit or loss, right? So you can think of this put position, let me explain. So this is the kind of put position. So you can think of a put position as owing someone $600, right? As owing someone $600 every time a price rises slightly, which means you lose when the price rises. To stop losing, you take the opposite side. You buy something that gains $600 when the price rises. That cancels the loss. So if you are owing $600, buy plus 600 worth of thing, simple offsetting. So just remember in one word, if I want to summarize this, all these things, whatever I have talked just now, just remember this key point. Please remember it. So whenever you see this word, delta hedge, right? So delta hedge, you take the opposite. You take the opposite position equal to how much? Notional multiplied by delta. You take the opposite position. If the result is negative, suppose the result is negative, buy that amount. See, if the result is negative, you buy that amount. Or if the result is positive, right, you sell that. Summarize this delta hedging in just 1 minute. Compute the delta equivalent and take the opposite position. That's it, right? That is how you can compute it. And if you, I hope this is crystal clear right now. Now, friends, let's see the next question that we have. Yes, high kurtosis. Very good question it is. So the question is asking basically kurtosis, which is a concept in statistics that help us understand the shape of return distribution in finance. So the question is, which of the following best characterize, right, basically a probability distribution for a portfolio return that exhibit high kurtosis? Options are: the distribution has a flattened center with a very short tail, indicating low frequency of extreme value. Option B says that it features a prominent central peak around the average and exhibit higher chance of outlier return due to heavy tails. Option C, the distribution is uniform with no pronounced peak or tails. And option D, there is a broad spread in the middle and extremely thin tails, meaning very few extreme gain or losses. These are the options that we have, right? So friends, let's understand. Let's see first of all, let's understand the meaning of high kurtosis. So whenever I say that kurtosis is high, it means the distribution is very peaked at the center, right? Distribution is peaked at the center. Please remember it, right? So that is the meaning of high kurtosis. Distribution is peaked at the center, right? Which means most value are close to the average. Like if you draw the normal distribution curve, it looks something like this. It's all maximum values are near the normal. This is the average. Okay, but it has also a fat and heavy tail. It will also have a fat and heavy tail, right? Which means that more chance of extreme events like big gain or big loss. That is called high kurtosis. So whenever I say this high kurtosis, it means two things. Please understand it. It means that it is peaked at the center, which means most value are close to this average. It also means that it has a fat or heavy tails, which means that more chance of extreme event. So in finance, if a portfolio has a high kurtosis, you might usually see a stable return. Yes, in the context of finance, what you will see the stable return. But sometimes, sometimes very big surprises, either very good or very bad, right? Think of it like this. Most of the time, you are driving on a smooth road at average speed, but occasionally you hit a huge pothole or a speed bump that shake everything. That is a fat tail. That is called, fat tail. You hit a pothole or you hit a speed bump that shakes everything. So that is a fat tail. It is quite rare but extreme outcomes, right? Now let's look at the options that we have. Option is that flattened center with very short tail. That's completely wrong. Why? Because that is actually low kurtosis. It indicates what? It indicates low kurtosis. right? It means everything is more spread out in the middle and extreme events are very rare, opposite of what we want right now. What about option B? Yes, it is the correct one. You can see now, prominent central peak around the average and higher chance of outlier return. Yes, very good. This is the correct one. What about C? C says that distribution is uniform. See, that is when outcomes are equally likely, right? Like a rolling of fair dice, no peak, no fat tail, definitely not kurtosis. What about D? It says that there is a broad spread in the middle and extreme thin tail. Again, this means very few extreme, that is low or normal kurtosis, not too high. So friends, please remember what we learned from this question is that whenever you see high kurtosis, two things must keep into your mind. See, if I say high kurtosis, it means tall peaks. Let me write it down. It means tall peaks plus tall. It will be very tall, right? Very taller plus fat tail. Just remember these two words, right? And more chance of outlier, more chance of extreme event. And this is important for portfolio risk analysis because extreme loss are more likely. So high kurtosis means high chance of extremes, even if average low. Now friends, let's see this particular question. It is asking you, a portfolio manager, he decides to invest in a long-term bond despite current low yield, right? A portfolio manager, he decides to invest in a long-term bond despite current low yield. Apart from anticipating a further decrease in the interest rate, what is another strong reason for such a strategy, right? So very good question. Options are maximizing short-term profit, meeting future liability commitment, increasing trading volume. D says gaining media attention. See, what do you think is correct? So let me explain. So what happened? Many institutions like banks, right? Many institutions like banks and insurance companies, pension fund, they know that they have to pay a large sum in the future. For example, pension payment, insurance claim, or maturing deposit. So buying long-term bond that mature around the same time as those payment means the institution will have the money exactly what is needed, right? When needed. See, I think you know it very well that these kinds of institutions like pension fund, mutual insurance and banks, they know it very well that they have to pay a large sum in the future. They are familiar with this thing, right? What? To pay large sum in future. Now you think about it. How do we get this large sum? So what they do, they invest in a bond which have a longer maturity and maturity around the same time as those payment means, right? It means that institution will have a money exactly when required. So this practice is called ALM, asset liability management, right? Matching the timing and size of the asset to the future liability to reduce the risk. Obviously, through this ALM what they are doing, they are reducing the risk, right? I hope it is clear because they have a future liability of paying the depositors, and then to meet that future liability, what they require what some kinds of investments in the bonds, right? Even if yield are low today, matching future cash need is often more important than chasing a small star return. Imagine that you must pay your child college fee in the 10 year. You buy a 10-year safe bond now so that you are sure that money will be there at the right time. You are not trying to make quick money. You are securing a future payment. That is what you are doing. Now let's look at the option. So the question is why? Why this is one of the strong strategy? Option A, maximizing short-term profit. See, this is wrong because long-term bonds are held for medium or long horizon, not for short-term gain. Buying long bond when yield are low is usually not a play for quick profit. Option B, meeting future liability commitment. Yes, that's the correct one, right? Now option C, increasing the trading volume. See, this is wrong. Why? Institutional strategies like ALM, they focus on holding and matching cash flow, not boosting the trading activity. Increasing volume is not a meaningful reason to buy long bond for liability matching. What about the gaining media attention? This is also incorrect because this is wrong and this is irrelevant. Portfolio decisions should be driven by risk management and the cash flow need, not publicity. Media attention is not a legitimate investment rationale. So the correct answer to this question is option number B. Please remember, the primary reason is matching the future liability. This is the primary reason. Matching the future liability, that is our ALM. This ensures that funds are available when the payment fulfilled due. Long bond can provide predictable cash flow at the right time even if current yield are low. And this is not for short-term profit. Trading, not for trading volume or publicity. Please remember it. So one line you can remember it. If you pay money later, buy an asset that pay when you must pay. Right? That is an ALM. I hope this is crystal clear right now. Friends, I'm just wrapping up this session right now. If you want me to see, we have 100 questions available, and this PDF is available in our course. Course name is CTP course, which includes unit-wise theory, unit-wise MCQs, previous year question, as well as the capsule content. If you want to grab this, please WhatsApp me on this particular number, or in the description section of the video, you will get the link to access the course. So if you want me to bring the part 2 lecture of it and explain like I'm explaining right now, please just write yes in the chat box, in the comment section. Right, I will bring the part 2 also. I hope this video was useful for you. Please hit the like button, share with other CTP aspirant, and so it like they move in an opposite direction. You can think of them like seesaw, right? So if the interest rate goes up, suppose interest rate goes up, what will happen? Bond price will go down, and vice versa. For example, imagine you own a bond paying 5% interest. You own a bond paying 5% interest. Suppose the new bond goes down. Suppose interest rate goes up, so bond price will go down. Just I am giving you the example. Suppose you own a bond that pay 5% interest, and now if the new bond just pay only 6%, so what will happen? This bond will become less attractive. Your 5% bond will become less attractive, so its price will drop. So there are 3 bond price scenario. Let's have a look. So let me write down here bond price. Let me show you the table only. So yes, this table I'm talking about. See this table. These are the 3 scenario. See, this is not just a MCQ session. I'm trying to give you the concept that will help you solve such kind of question. First thing is that if the bond price is less than the face value, so this is called selling at discount. Because market price of the bond is less than the face value, it means you are selling at the discount. And in that case, YTM, that is yield till maturity, is larger than the coupon rate. And if the market price of the bond is more than face value, then we are selling it at premium. And in that case, coupon rate will be higher than the YTM. And if the market price of the bond is equal to the face value, you are selling at par, and YTM is equal to the coupon rate. So let me give you one example to make it more clear. For example, suppose a $1,000 bond is there, right, with 5% coupon. $1,000 bond, 5% coupon, and suppose it is sold for $900, right? So obviously it is a discount, because you are selling at just rupees 900, where the face value is $1,000. So in this case, YTM is higher than, in this case the coupon rate is 5%. So in this case your YTM will be larger than 5%, right? Because you are paying less for the same income. YTM will be larger than the 5% because you are paying less for the same income. Because you are basically, what is happening, that same $1,000 bond with 5% coupon sell for $900, right? So you are paying less, so its YTM is increasing. YTM is what? Yield. So yield you are getting more because you have to pay less, because it is a discount, right? And suppose if you sell the same bond, if you sell right, so suppose if you sell it for if you sell it for $1,100, which is a kind of premium, so in this case YTM is lower because you are paying extra, so your return is less. Obviously, since you are paying extras to buy this particular bond, you have to pay $1,100, but its market value is just $1,000. So in that case, basically face value is just $1,000. So in that case you are paying more. Since you are paying more, so your YTM will decrease. So please remember this table, and using this table you can answer all the questions. Let's see the option. Option A, if the bond is trading at premium, is YTM is higher than the coupon rate. Option B, if the bond is trading at par means market price is equal to the face value. If a bond is trading at par, coupon rate is equal to YTM. Option C, when interest rate fall, bond price also fall. Option D, bond price and market yield always move in the same direction. So see, which option tells you the correct picture? So obviously it is option number B. Yes. So if the bond is trading at par, its coupon rate and YTM will be same. B number is correct. What about A? A says that bond is trading at premium, its YTM is higher than the coupon rate. See, just now I told you, suppose a bond is trading at a premium, it means that you have to pay more, and since you are paying more, so YTM will be less. So this is not the correct answer. What about option C? If interest rate fall, bond price also fall. This is just the reverse, because price rise when the rate drop. We know it very well. So C is incorrect. What about option D? Bond price and market yield always move in the same direction. See, this is opposite. They move in the opposite direction. So option D is also incorrect. So the correct answer to this question is option number B. I hope that makes sense to you. Now friends, let's look at the next question that we have. The next question is related to the certificate of deposit. So the question is like this. Suppose you are thinking about saving money safely while earning interest. So a certificate of deposit could be a great option. But how does it work? Let's see this particular question. The question is, which of the following correctly describe the key properties of a certificate of deposit? So option A say that a certificate of deposit is a flexible saving account with no fixed term, offering variable interest and unlimited withdrawal. Option B say that CD is a time deposit offering fixed or variable interest over a predetermined time and is insured and typically incur penalty for early withdrawal. Option C say that CD is an equity linked investment tied to a stock market performance and carry higher risk but potential higher return. And option D say a CD allows continuous additional deposit throughout its term and is not insured by any government agency. So basically, first of all, what is CD? A CD, you can think of CD as, is a kind of time deposit, right? You agree to lock your money away for a fixed term, like 6 months, 1 year or 5 years. In return, the bank pay you interest. What you will get in return? The bank pay you interest. Plus, you also get interest usually at the fixed rate. Let me give you one example to make it more clear. For example, suppose you deposited $5,000, right, in 1 year certificate of deposit, right, at 4% interest. So you deposited $5,000, 1 year certificate of deposit, 4% interest. So after a year, you get back how much? You get back, after a year, you get back $5,200. Your original money plus $200 as interest. So that is the point. That is about CD, certificate of deposit. So what are the key terms, key features of CD? So if you talk about the key features of CD, first of all, the term is fixed, which means, you can't withdraw early. You can't withdraw. This is the first point. Second point is, guaranteed interest. Guaranteed interest. Unlike a stock, your rate is locked in. Your rate is locked, guaranteed interest you get. And I told you that it is FDIC and NCUA NCO, which means up to $2 lakh. Remember, in the US, if we talk about $2.5 lakh, right, it is insured. Your money is safe even if the bank fail in the US. And early withdrawal penalty is there. If you withdraw early, if you take money out soon, you will lose some interest. So friends, let's look at the option. Option A says it is a flexible saving account with no fixed term. This is completely incorrect because CD have a fixed term and penalties are there. It is saying that unlimited withdrawal. No. There are penalty for early withdrawal. Option B is saying that it is a kind of time deposit offering fixed or variable interest over a predetermined term and is insured and typically incurs penalty for early withdrawal. Yes, completely correct. B is the correct one. What about option C? It is equity linked investment. No, it is completely wrong. CD are low risk investment and does not depend on stock. And D say it allows extra deposit. No, it is false. Once you open a CD, you can't add more money later. So let me give you a real life example to make all this concept more relatable to you. Suppose you have $10,000, right? Suppose you have $10,000. Suppose you have $10,000. So that you won't need for 2 years. So this $10,000 you won't need for 2 years. So you have two options. Option number 1 is to put it in saving account. Option 1 is to put in the saving account. It's quite flexible, but it offer you low interest. And option 2 you have is to lock in for 2-year CD, 2-year certificate of deposit. You lock it in for 2-year certificate of deposit at 4.5% interest. You lock it for 2 years certificate of deposit at 4.5% interest. And after 2 years, right, after 2 years you will get how much? After 2 years you will get $10,900, right, dollar. So out of which 10,000 is your principal plus 900 is your interest. But if you withdraw early, you might lose 3 months of interest as penalty. Right, if you withdraw it early, you might lose, that is called withdrawal penalty. Early withdrawal typically incurs penalty. So let's recapitulate what we have covered in this particular question. So what I told you that these points are regarding the CD, certificate of deposit. So the first point is that they are like time deposit. CDs, they are like time deposit. Okay. Then we talked about that higher interest than regular saving. Right. So they offer you higher interest rate as compared to regular saving. But there are penalties for early withdrawal. Yes, there are penalties for withdrawal. For withdrawal there are penalties. Then I told you it is quite safe
and it is insured, quite safe and insured, like FDIC, NCUA, up to 2.5 lakh dollar in US. And I told you they are not flexible. Not flexible means what? No extra deposit or easy access before maturity. So these are the 5 points which we need to keep in mind regarding the CDs. Now friends, let's switch our focus to the banker acceptance, or we call it BA. So ever wondered how big companies safely pay for good across border? So enter the banker safety acceptance, or BA, a handy financial tool that make international trade smooth and secure. Let's break it down in simple terms. What is this banker acceptance? So the question is, which of the following correctly defined banker acceptance? Option A negotiable equity security guaranteeing ownership right in a bank. Option B, a short-term debt instrument issued on a foreign exchange contract with no bank guarantee. Option C, a time draft guaranteed by a bank for a future payment, negotiable in the secondary market, commonly used in the international trade. Option D, a long-term corporate bond secured by bank collateral. So first of all, the question is, what is this BA, or what is this banker acceptance? See, it is like short-term IOU. It is like short-term IOU. What is IOU? Like a post-dated check. Short-term IOU, like post-dated check, right? That a bank guarantee. So it is used mostly in the international trade. They are used mostly in the international trade, right, to ensure that seller get paid on time. So mostly this banker acceptance is used in the international trade to make sure that seller get paid on time. To make sure that seller get paid on time, right? For example, take the case of US importer. Take the case of US importer, right, which buy electronic from Germany. This US importer, it buy the electronic from Germany. Now the German seller want payment security. So the importer bank issued a banker acceptance promising to pay in 90 days. So basically that is the use of this banker acceptance. I told you now that is used in the international, it is used in the international trade, right? Suppose a US importer is there, and this particular US importer, he buy electronic from Germany, right? The German seller want payment security. So the importer bank issues a BA promising to pay in 90 days. Now let's look at how does it work. First of all, if we look at the how does it work, then there is something called bank guarantee, BG. The bank say that we will pay if the buyer can't. That is called BG, bank guarantee. Second point is that it is short term. This is for short term, which means usually last 30 days to 180 days. It usually lasts 30 days to 180 days. Third point, I told you, they are tradable. Tradable means what? It can be sold to other investor at a discount. At a discount, you can sold it to the other investor before the due date. And the fourth point is risk is quite low, which means since a bank back it, yes, bank is backing it, so low risk is there, right? So friends, let's look at the option. Option number A say a negotiable equity security guaranteeing ownership right in a bank. No, this is wrong, because BAs are debt. Remember, banker acceptance are like debt, right? They do not own ownership in a bank. What about option B? A short-term debt instrument issued on a foreign exchange with no bank guarantee. See, this is wrong. This word is wrong. No bank guarantee is wrong. Actually, the whole point is the bank promise. The whole point is the bank promise. This is the whole point. What about option C? A time draft guaranteed by a bank for future payment, negotiable in the secondary market, commonly used in the international trade. Yes, it is used in the international trade, negotiable in the secondary market, and used by the bank for future payment. Yes, all these points are covered. That's why option C is the correct. What about option D? A long-term corporate bond secured by bank collateral. No, this is also wrong. It is not a long-term corporate bond. Rather, it is a short-term corporate bond. It is quite short-term. So this long-term word is wrong. So if I provide you the real life example, take the case of Mexican car part. Supplier sell to Canadian buyer. Problem is that the supplier worry that buyer might not pay. Solution is that the buyer bank issues a banker acceptance saying that we will pay $1 lakh in 60 days. So the supplier can wait 60 days for full payment, and supplier can sell the banker acceptance early for $98,000 at discounted price to get the cash now. So let's recapitulate what we have covered regarding the banker acceptance. First of all, I told you that they are just like bank guaranteed IOU. First point I told you regarding this banker acceptance, that they are the bank guaranteed IOU, right? They are the bank guaranteed IOU, guaranteed by bank. First point. Second point is, they are for short term. They are for short term. Third point I told you, for short term basically means 1 to 6 months. Third point I told you, they are used in the international trade. Sorry friends, they are used in the international trade. And the fourth point is that they are not stocks. They are not long-term bond. They are neither stock, they are neither long-term bond. Rather, they are safe liquid investment. So these are the points that we need to keep in the mind. Now friends, let's look at about settlement risk. The question is, which of the following statement about settlement risk is accurate? Yes. So let's see the option. Settlement risk arises when a party failed to fulfill its obligation at settlement, such as delivering security or cash. Option B. Settlement risk is exclusive to the stock market and does not apply to the foreign exchange. Option C. Settlement risk can be fully eliminated by simply using clearinghouse. Option D. Settlement risk refers only to the timing delay in settlement but not to actually non-delivery. So friends, imagine you sell your bike online, ship it first, but the buyer never pay. That is a settlement risk. In a nutshell, in finance this risk happens when one party does not hold up their end of the deal. Let's break it down with a real world example. First of all, we are talking about the settlement risk, right? So the danger that one party deliver but the other party does not. This is the danger that one party deliver but other does not. Right, that is called settlement risk. It is also called Hostad risk. It is also called Hostad risk, which is named after a 1974 German bank collapse during a foreign exchange trade. So suppose, let me give you one example of this settlement risk. Suppose you wire $10,000. You wire $10,000 to buy stock. You wire $10,000 to buy stock, but the seller never transferred the share. The seller never transfer the share. So that is the settlement risk. Now the question is, where does it happen? Yes, this is a very or bond or forex or derivative. Fine, not just one market. And most commonly, it is most common in the forex trade. This settlement risk is most commonly seen in the forex trade. Why? Due to time zone difference. Yes, this time zone difference plays a critical role. The reason is, time zone difference. Right. For example, one bank pays in euro before receiving dollar. Right. And if you talk about the types of settlement risk, so there are two types of settlement risk. The first one is called default risk. What happened in the case of default risk? Suppose two parties there. Party A send money. Party A send money. But party B never deliver. Party B never deliver. Right. The goods. Party B never delivered the goods. So this is called default risk. And the second kind of risk that we have is called the timing risk. What is timing risk? Suppose party B deliver late. Party B delivered late, leaving party A exposed in the meantime. So these are the two kinds of settlement risk. First one is the default risk, and second one is the timing risk. Now the question is how to reduce the settlement risk. So if we want to reduce the settlement risk, so we can use this DVP system or PVP system, delivery versus payment. Right. So it ensures that both sides exchange assets simultaneously. Both sides exchange asset simultaneously. This is ensured by DVP versus PVP system. Second one is the clearinghouse. Yes, clearinghouse also plays an important role. They act like a middleman. They act like a middleman to guarantee trade. This clearinghouse act like a middleman to guarantee trade. Then the another way is netting. Netting is another way to reduce the settlement risk. So bank offset mutual debt to reduce what is on. Offsetting the mutual debt to reduce what is on. So let's look at the other option that we have. So first of all, option A says that it arises when a party failed to fulfill its obligation at settlement, such as delivering security or cash. Yes, this one is correct. What about B? It is exclusive to a stock market and does not apply to foreign exchange. This is completely wrong. I told you now. It often huge in the forex. There is a huge forex risk. Right, settlement risk is the huge in the case of forex. What about option C? It says that it can be fully eliminated by simply using a clearinghouse. No, they reduce the risk, but they cannot remove it entirely. What about D? This refers only to the timing delay in settlement, but not to actually non-delivery. So see, this is option D. If we talk about, and this is only about delay. No, it's not about delay. It's include complete failure also. So let me give you one example of the settlement risk to make it more clear. So take the example of US company. Suppose US company buy 1 million euro of goods. Suppose it buy 1 million euro of goods from France. Okay, France, payable in euro. That has to be payable in euro. The risk is that US bank send euro at 9 a.m. but the French bank failed before confirming dollar receipt due to time zone. The result is that the US company loses $1 million with no goods. That is called settlement risk. So let me summarize what we have covered so far in the settlement risk. I told you it is just like you paid but they did not receive. You have made the payment but they did not receive. That is settlement risk. Second point, I told you it happen in all market. This kind of settlement is it happen in all kind of market. It happen in all market, right? Especially forex market. Especially it happen in the forex market. And another name of this I told you, Husted risk. Husted risk name is same as this one. Then I told you it includes default. It includes default and delays. Default and delays are included. And how to reduce it? It can be reduced by DVP or PVP, right? It can be reduced by clearinghouse, and it can be reduced by netting, but never fully gone. Now you see why bank and trader worry about settlement is so much. Now friends, have a look at the next question. Friend, if you want such kind of content in form of videos, in form of PDF, right, you can enroll in our CTP course. CTP course, that is a course which is available on our app. App name is JIV and CIV made simple. Or for more detail, you can WhatsApp me on this particular number. Now friends, have a look at this one. Such type of numerical question are being asked regularly in the examination. So if you want to see how your money grow, let's break down how this rupees 20,000 which is you have invested at an annual interest rate of 8%, right, in 2 years, how it compounded annually. So the question is, what will be the future value of your investment? So first of all, let's understand what is this CI, what is this compound interest. So this is like interest on interest. So you earn return not just on your original money but also on accumulated interest. For example, like a snowball rolling downhill. What is the formula for calculating the future value? This is nothing but principal multiplied by 1 plus r whole to the power t. That is future value. So in this case, what is the principal? Principal is the 20,000 rupees. What is 1 plus r? R is 0.08. What is t? T is a 2 year. Fine. So compounded annually, yes, t is equal to 2 year and compounded annually, so n is equal to 1. So let's calculate it one by one. So it's quite simple to calculate, right? So what will be the interest for first year? Interest for first year will be 20,000 multiplied by 8%, which will be 1600. So total will be how much? Total will be 21,600. Now what will be the interest for year 2? 21,600 multiplied by 6%, sorry 8%. That will be how much? 1728. And if you add this 21,600 plus 1728, this will give you 2,328. So near about 472. This is the nearest option that we have. Context of bond. Let's understand the meaning of put in the context of bond. So basically a put option let bondholder demand early payment. It let bondholder demand early payment. Right. So put option let the bondholder so that bondholder can demand early payment. Early repayment before maturity. So bondholder can demand early repayment before maturity through the put option. This is the first point. So there are two type of put option. The first is called soft put. What is the meaning of soft put? Soft put, it means flexible repayment. Your repayment is quite flexible. That is called flexible repayment. And what is the meaning of hard put? So hard put, it means strict cash only. It is quite strict. It says cash only. That's it. So basically this soft put is a kind of flexible repayment. So what happened in the case of soft put? The issuer can repay you in. So in the case of soft put, in the case of soft put, whoever has issued the bond, they can repay you. The borrower can repay you. The borrower can repay you in cash. The borrower can repay you in subordinate notes, like new IOU. He can repay in stock or he can repay in mixture. Right. For example, suppose you hold a 10,000 rupees bond. Let me give you one example. Suppose you hold 10,000 rupees bond with a soft put. Suppose you hold 10,000 rupees bond with a soft put. Okay. So at redemption, what happened? At the time of redemption, when you want to redeem, obviously there is a time of redemption of the bond. at the time of redemption, the company might give you 5,000 cash plus 5,000 in share, right? So this is a kind of, soft put. So hard put, it is only cash repayment. Hard put means cash only repayment. So in the case of hard put, what happened? The issuer must repay in cash. No substitute for that. So same, take the case of same 10,000 rupees bond, right? With a hard put. Suppose it is a hard put. Okay. Same 10,000 rupees bond with hard put, right? So you get 10,000 rupees in a cash. So basically soft put is riskier for investor because you might get stuck with share or IOU instead of cash, and hard put, it is safer. Let's look at the question. The question is, the bond with soft put provision differ from the hard put. Option A says that soft put allow bondholder to redeem only in cash at the predetermined date. No, that is wrong, because soft put include all the case. Some part cash also, some part stock also, IOU also, not completely in cash. So option A is wrong. What about option B? Option B says that a soft put permit redemption in cash, subordinate notes, a stock, or a combination, while a hard put restrict redemption to cash only. Yes, this is the perfect answer. This is the correct answer to this particular question. What about option C? Short put means the bond cannot be redeemed early under any circumstance. That is completely wrong. Because short put does not mean that bond cannot be redeemed early, right? That is completely wrong. And option D says that soft put forces redemption only through the bond issuer conversion into equity at maturity. No, soft put offer choice. Soft put will offer you choice, right? So not force conversion. So let me give you a real life example to understand this soft put. So suppose your friend repay a loan by cash, by new IOU, or his bike. So that is a kind of soft put. And what is hard put? Suppose your friend must pay cash. Your friend, he must pay cash. So in case he must pay cash, right, that is a kind of hard put. No bike, no IOU. So let's recapitulate what we have covered so far in this particular session. So we have talked about the soft put. What is the meaning of soft put? I told you, issuer can repay in cash, issuer can do the cash payment, he can repay in notes, he can repay in stock, or he can have combination of all this, right? Then we talk about the hard put. What is the meaning of hard put? Hard put, I told you, it is just cash only prepayment. It is the repayment will only be made in the form of cash. So one more thing I told you, the soft put are riskier. Why soft put are riskier? Because you might not get cash. And hard put, hard put are quite predictable. Why it is quite predictable? Because cash is guaranteed. Since cash is guaranteed, so this hard put is predictable. So now you will never mix up soft and hard put. I hope this is clear now. Now friends, let's switch our focus to one question on state government security valuation. So question is, according to the RBI valuation norm, how are state government security typically valued? Right, this is a very good question. So ever wondered how banks and mutual funds decide the value of a state government bond? That is what we are going to discuss. So how they decide the value of a state government bond? The RBI has a simple rule. What does RBI say? That take central government rate and add 0.5%. So let's see the question. Option A says that based on actual market price only without any adjustment. Option B, at uniform markup of 25 basis point of central government security of equivalent maturity. Option C, at a 50 basis point markup above the yield on comparable central government security as published by FBIL. Option D, using book value accounting or carrying cost, whichever is lower. So this is a very good question. So there is a golden rule. The golden rule is 50 BPS markup. 50 BPS markup. So what does it say? That SGS means a state government security. They are always valued. SGS are always valued 0.5% higher. They are always valued 0.5% higher than CGS of the same maturity. Remember, this is the RBI rule. This is called golden 50 BPS markup, which says that a state government bond or SGS, a state bond are always valued 0.5% higher than the CGS of the same maturity. Right? So that is what 50 BPS markup, golden rule. Why it is so? Because the states are slightly riskier than the central government. This is very much important that states are riskier than the central government. Right? Like choosing between national brand versus a state brand. Let me give you one example to make it more clear. Let us take one example here. So for example, let's suppose that a 10-year central bond. 10-year central bond is there. So they yield 7%. 10-year central bond yields 7%. And a similar state bond, right? A similar state bond will be valued at 7.5%. So basically that is why, since state bond are slightly riskier than the central bond, so higher the rate. That is the basic rule. So where does the data come from? Yes, the data come from FBIL. What is FBIL? Financial Benchmark India Limited. They publish, central bond yield data every times. So basically, the data which is published by FBIL, this is used by bank, right? To use this rate, bank use the rate that is published by FBIL plus add 0.5% for state bond. Since they are more riskier, so more reward in the form of interest rate. But there are some exceptions. What are exceptions? Suppose a state government bond was traded in the market within 5 to 15 days. Suppose a state government bond was traded in the market within 15 days, right? So in that case, it actual trade price override the 7.5%. It actual trade price override the 7.5%. Let me give you one example. Suppose take the case of Tamil Nadu. Suppose Tamil Nadu 10-year bond. Suppose Tamil Nadu 10-year bond was recently sold at 7.3% yield. Recently sold at 7.3% yield. So what will be the value? It will be valued at 7.3%, not 7.5%. This is the very important thing. Again I am repeating. Suppose Tamil Nadu 10-year bond was recently sold at 7.3%. So it will be valued at 7.3%, not 7.5%. Let's see the option that we have. First option say based on actual market price only without any adjustment. See, this is wrong because RBI mandate 50 BPS rule. Remember, there is a 50 BPS rule unless recent rate exists. Then option B, at a uniform markup of 25 basis point of central government security of equivalent maturity. This is also wrong. This was the old rule. This was the old rule, right? Updated to 50 BPS now. Option C say at a 50 basis point markup we have the yield on comparable central government security. Yes, this is the correct one. Option D say book value. So this is not for bond. Basically what RBI use? RBI use yield based valuation. RBI used yield based valuation. It is saying using book value accounting. No. It is no longer book value accounting. Rather it is yield based valuation. So let me give you one example to make it more clear. So take the case of central bond. Take the case of central bond. So central bond, just like branded sugar, right? Just like branded sugar. So branded sugar, they offer you 7% interest on the bond. And if we talk about the state bond, right? Take the case of a state bond, like local kirana store. Local kirana store, right? They offer you 7.5% interest. Same product, but you pay slightly more for trust issue. Let's recapitulate what we have covered so far in this particular session. So in this particular question, I told you that a state bond is equal to, right, central bond yield, central government bond yield plus 0.5% always. Remember it. Second point I told you, source, right? Source I told you, this is the FBIL's published central government yield. FBIL published yield, that is the source. Then one exception I told you, right? I told you one exception. What is the exception? It is that recent market trend. Yes, exception is the recent market trade. Recent market trade override this, 0.5% rule. Recent market trade override the 0.5% rule. That is the exception. And the answer is why? Why so? Why it is riskier? The reason is that, states are riskier than the central government. In terms of risk, state bonds are riskier than the central government. That is the point. Now you know why your debt fund state bond is priced that way. Now friends, let's look at one more question, very very important from examination point of view. So imagine you are buying a chocolate bar today versus a promise to get one next year. The price difference is like the spot rate curve. It tells you the exact cost of money at different future date. That is the question. Which statement best describe the spot rate curve or zero coupon yield curve? So options are, it represents the yield to maturity of a coupon paying bond at different maturity. Option B say it is constructed from zero coupon bond yield and used to discount each cash flow at a specific maturity rate. Option C say it shows forward interest rate for future period derived from future contract. And option D say it is the same as the traditional treasury yield curve based on par yield. So first of all, let's understand what is the meaning of this spot rate curve. So basically, it is a graph of interest rate for zero coupon bond. So when we talk about this spot rate curve, so basically it is a kind of graph. Graph of what? It is a kind of graph for interest rate. Interest rate for what? Interest rate for zero coupon bond. It is a graph of interest rate for zero coupon bond. What is the meaning of zero coupon bond? Zero coupon bond are those bond that pay no interest. Bond with no interest, that is called zero coupon bond. So basically this spot rate curve is a graph of interest rate for zero coupon bond. Right, suppose we have zero coupon bonds, we have their interest rate, we are going to show it on graph, that is called a spot rate curve. So for example, let me give you one example, like 1 year zero coupon bond yield is 5%, 2 year zero coupon bond yield is 6%. So the curve plot these rate over the time. So basically on the y-axis you have the rate, on the x-axis you have the time, and you plot this rate over the time. Why it is useful? It is useful because it provides you accurate bond pricing. It provides you accurate bond pricing, which means instead of using one average rate, which is the YTM, the spot curve discount each future cash flow at its own rate. For example, let's take the case of 2-year coupon bond. Suppose take the case of 2-year coupon bond. Okay, so year 1 coupon is discounted at the 1 year spot rate. Year 2 coupon is discounted at the 2-year spot rate. That means it shows you the accurate bond pricing and how it is built, how this kind of a spot rate curve is built. Since most bond pay coupon, so there is a math trick that is called bootstrapping. That is what we call bootstrapping. You see this word written here. So basically this bootstrapping extract implied zero coupon rate from them. Like figuring out the price of plain flour by subtracting the cost of egg and sugar from the cake total price. That is called bootstrapping, right? So bootstrapping is used to derive the spot rate from the coupon bearing bond price. Now let's see the option that we have. Option A say it represents the YTM of a coupon paying bond at different maturity. So that is wrong. Basically that is called normal yield curve. That is not called spot yield curve. That is called normal yield curve. What about option B? It is constructed from zero coupon bond yield and used to discount each cash flow at its specific maturity rate. Option B, option B is correct. That is what I am talking about. It is constructed from zero coupon bond yield and used to discount each cash flow at specific maturity rate. Option C, says that it shows forward interest rate for future period derived from future contract. So that is wrong because forward curve are derived from spot curve, not the same thing. And option D say that it is same as the treasury per yield. No, par yield. No, that is wrong. Par yield curve use bond price at face value. Par yield curve use, they use bond priced at face value. Right. While a spot curve use zero coupon rate. I already told you that, par yield curve, they use bond price at face value, but they while a spot curve use zero coupon bond, right? So that is what the difference between zero coupon bond and this kind of thing. So basically let me give you one example to make it more clear. So first of all, you can think of this spot curve as as a menu of today's price. You can think of a spot curve as a menu of today's price for rupees 100. Today's price for rupees 100, delivery in 1, 2 or 5 years, right? So 100 rupees in 1 year will cost 95.25, 100 rupees in 2 year will cost 89 rupees. So traditional yield curve is the average all these things into one combo meal rate. So let's recapitulate what we have covered in this particular slide. I told you about a spot rate curve. I told you about a spot rate curve. What it is? This is a kind of zero coupon bond. This is a kind of zero coupon bond yield. Yeah, zero coupon bond yield across maturity. Zero coupon bond yield across maturity. That is called a spot rate curve. First point. Second point, I told you that you need to discount each cash flow separately. Yes, discounting of each cash flow is to be done separately. Discount each cash flow separately. And the third point I told you, it is built by a bootstrapping. This kind of a spot rate curve is built via bootstrapping. I hope that makes sense to you. Now friends, have a look at one important concept, right? So this is based on let's talk about this. So if 1 USD is equal to this much rupees, if 1 USD is equal to this much Canadian dollar, what is the cross rate for 1 Canadian dollar in INR and what concept does it represent? So basically what is the meaning of this cross rate? Let's first understand it. Basically whenever we say cross rate, it is a kind of exchange rate. Exchange rate between two currencies. It is a kind of exchange rate between two currencies like INR and CAD, Indian rupees and Canadian dollar. It is calculated using a third currency like dollar. It is calculated using a third currency. Why? Because USD is the most traded currency globally. It's act like a bridge. Now let's see this particular question. In this particular question, $1 they have given 61.50 rupees, and $1 they have given CAD 1.1377. Okay, so we have to find that how much CAD, how much both are related, right? So basically, if we equate both of them, right? So we can say, we just equate both of them. We can say 61.50 rupees is equal to CAD 1.1377. Okay, so basically we can say that 1 CAD will be equal to 61.50 divided by 1.137. So that will be equal to, we can say 0.8789 1 CAD. Fine, this much dollar. Now you have to convert, so 1 CAD is equal to this much dollar. So basically what we have done here, see, yes, we have seen 1 CAD is equal to how much USD. That is what we have done just now. So basically, yeah, so what we got is 1 CAD is equal to this much. How much we get is, this will get 54.05. Just wait a minute, let me correct it. So if you just equate both of them, you will get 54.09. Fine, you will get how much? 54.05, this much rupees. So 1 CAD, 1 Canadian dollar is equal to 54.05 rupees. That is the correct answer. So let's see the option that we have. Option A say 53.40. That is incorrect. That is incorrect, right? Because this is incorrect math. What about option B? 69.98. That is incorrect. What about option C? Yes, it is correct. Option D is also incorrect, right? So imagine you are trading apple and oranges, but no one trade them directly. So instead what you do, everyone trade apple for banana and orange for banana first. So to find out how many apple is equal to 1 orange, you first find out how many banana is equal to 1 orange and then convert banana into apple. So that is the meaning of cross rate. So basically, whenever we say cross rate, let's understand what we have covered in this particular question. So I told you about the cross rate. What is the meaning of cross rate? Cross rate is a kind of exchange rate. Cross rate is a kind of exchange rate for two currency. We are finding the exchange rate for two currency via third currency. Via third currency, we are finding exchange rate for two currency. And the formula is quite simple. Suppose we want to find INR oblique CAD, which is equal to INR oblique USD divided by CAD oblique USD. That's it. And USD is act like a bridge currency. This US dollar, it acts like a bridge currency, right? That is the point. Now friends, let's look at the last question of today's session. The very good question which was asked in the examination. It is regarding the strips. Yes, just wait a minute. Yeah. So it is regarding the strips. Very good question. Question is, which of the following statement best describe strips in the context of government security? So very good question it is. Imagine taking a chocolate bar with layer and splitting into individual pieces. That is exactly what strips do with the government bond. So what is strips? So first of all, let's talk about the full form of it. So basically its full form is separate trading of registered interest. Separate trading of registered interest and principle of security. Separate trading of registered interest and principle of security. So what they do is split a regular government bond into coupon payment. So if we talk about the strip, what they do, they split a regular government bond, that is called government security, is split into coupon payment. Government security is split into coupon payment plus principal repayment. Right. Let me give you one example. For example, let's take one example. Suppose 10-year government security with 10,000 rupees face value plus 6% annual coupon. 6% annual coupon. Right. It can be stripped into 20 coupons. It can be stripped into 20 coupons strips. Okay. So which is almost 300 rupees each, paid semi-annually. Fine. And one principal strip is there. One principal strip is there, which is how much? 10,000 rupees at maturity. So that is what it does. Basically, it converts a government bond. This is a 10-year government security of 10,000 rupees face value. It is converted into two parts. First of all, 20 coupon strip is generated. 20 coupon strip, rupees 300 each, right? And one principal strip, which is rupees 10,000 at maturity. So let's summarize what we have covered in this particular question, right? So basically, if you talk about the key feature of this strip, this is a kind of, zero coupon bond. Remember, this is a kind of zero coupon bond because each strip pay no periodic interest. You know, each stripe, they pay no zero periodic interest, just one lump sum at maturity, and they are traded separately. Which means, you know, investor can buy, investor can sell individual strip. For example, only the 5-year coupon or the principal. And you know, one more thing is that they are SLR eligible. Yes, they are eligible for SLR. You can see that bank can count them toward a statutory liquidity ratio. And why does a strip matter? A strip matter because of, you know, flexibility they offer. Investor can pick a specific cash flow. For example, only 3-year coupon. Yes, they can do that. Pricing clarity. Since there is zero coupon, their price directly reflect the time value of money. So let's see the option that we have. Option A say that strips are equity instrument issued by RBI carrying annual interest and market linked pricing. No. Again, it is wrong because they are not equity instrument. They are basically debt instrument. First of all. Option B say short term treasury bill. No. They are not short term treasury bill because I told you this is also wrong because I told you they are long term zero coupon bond. They are long term zero coupon bond. What about option C? Yes, this is the correct. Zero coupon security created by separating coupon and principal component of fixed coupon GSEC and are eligible for SLR. Yes, completely correct. Option D say corporate debt instrument. No, it is again wrong. Strips come from government bond, not corporate. Think of a magazine subscription. Regular bond, you get 12 monthly issue plus one free gift, which is a principal at the end. Similarly, in the strip, what happened? The publisher let you buy or sell each issue separately. Only the July edition or just the gift. That is the point. So let's recapitulate what we have covered regarding the strips here. So I told you, whenever we talk about these strips, you must remember they are unbundled government security, right? Which includes coupon payment plus principal. They are traded separately. Second point I told you, they are, you know, zero coupon bond, which means, you know, no periodic interest. No interest is being paid. Only just one payout. Third point I told you, they are SLR eligible. Right? Bank can use them to meet reserve requirement. And the fourth point is that they are not equity. Right? They are not equity and neither corporate debt. They are neither corporate debt. So friends, before ending our lecture, let's summarize what we have covered so far in this particular lecture because, you know, revision is must. So let's see whatever point we have covered, just summary, because you know why we go through this question to have a conceptual clarity. So let's see what concept we have gone through. So first of all, we started with, you know, the first question we started with a kind of bond and YTM relationship. I told you that interest rate increase, bond price decrease, interest rate decrease, bond price increase. And one more point, if market price of bond is less than face value, then in that case YTM exceed coupon rate and vice versa. Then we discuss about CD, which means, you know, certificate of deposit. I told you higher interest rate, they offer higher interest rate than regular saving account. Yes, there are penalties for withdrawal. It is safe and unsecured and they are not flexible. Right, these are the point, right, that you talk about. Then we talk about, you know, banker acceptance. What are the point regarding banker acceptance that is worth noting? I told you that, you know, banker acceptance is that first of all 100% bank guarantee, short term instrument generally for 1 to 6 months, right? Not stock. As you can see, instrument type is short term debt, guarantee is bank guaranteed. Negotiability, yes, they can be negotiable, they are transferable in the secondary market. We are talking in the context of banker acceptance. Maturity typically 30 days to 180 days, and primarily they are used to facilitate international trade payment. Then we talk about the settlement risk. What I told you that settlement risk is key point. Let me summarize. Yes, I told you that you paid but they did not receive, right? That this is also called Husted risk. You paid but they did not receive. It is called settlement risk. It is another name is the Husted risk. So default risk and delays risk, two types of risk. It can be, you know, it can be minimized or it can be taken care of using DVP, delivery versus payment, or PVP, right? These are the point. Then we talk about the time value of money, how to find the future value. Then we already discussed the formula. We talked about what is the meaning of soft put and hard put. I discussed soft put, you know, it helps issuer can get in the form of cash, notes, stock and combination. It's quite riskier. When we talk about hard put, just cash only. If you have to make repayment in cash and the face value of bill is given ₹100. So now the question is, what is the yield of the treasury bill? Options are 9.65%, 9.86%, 10.39% and 10.65%. So friends, first of all, understand the question. First, remember that treasury bill are short-term government security. They are issued at a discount and they are redeemed at the face value. So you earn money by buying low and getting ₹100 at the end. So you earn money by buying low and you get rupees 100 at the end. Right. So there is a formula that we use to calculate the yield. And what is that formula? Yield is equal to 100 minus P upon P, the face value. Right. So remember, for treasury bill, rupees 100 is the face value always. Now P is the purchase price. What is P? P stands for the purchase price. Okay. Then comes D. What is D? D stands for the tenure of the bond. And in this case, as you can see, the tenure of the bond is 91 days. As you can see here, tenure is how much? 91 days. Okay. So now this is the formula which will be used. So it is just substitute the value. So 100 minus purchase price. What is purchase price? It is, the purchase price is 97.50, as you can see written here. Discounted price means purchase price. So 100 minus 97.50 divided by 97.50 multiplied by 365 by 91 into 100. So this formula you have to apply. So it will give us 2.50 upon 97.50 multiplied by 4.010989 and multiplied by 100. So ultimately it will give you 10.39%. So option number C is the correct one. Right. So I hope I request you to please remember this formula. Sometime what happen? They give you the price and they ask you the yield, and sometimes they give you the yield and ask you the price. So both way you can find the concern. So what we learned from this question is that treasury bill are short-term loan you give to the government, and you buy them at cheaper rate. Like in this case, you have bought them at 97.50 rate, right? And you will get rupees 100 later. So this difference between these two number is your profit. The difference between 100 and 97.50 is your profit. And if you want to find the annual return, what is the meaning of yield? Yield just means annual return. So if you want to find the annual return, you can use the formula y is equal to 100 minus P upon P into 365 upon D into 100. So after putting the value, the answer is 10.39%. So the next time you get a treasury bill MCQ, don't panic. Just plug the value into the formula and solve the step by step. Now friends, have a look at the next question. Next question is, which of the following is not included in the computation of NDTL for CRR and SLR purpose? Right. So there are 4 options which has been given. So friends, options are interest accrued on deposit, borrowing from RBI and refinance from NABARD, Exim, etc., credit balance in the current account, liability arising from the interest-free court receiver deposit. So these are the options. So not included in the computation of NDTL. That is what it is asked. So first of all, let's go through the option number A. That is the interest accrued on the deposit. This means that interest that is yet to be paid but already due on saving or fixed deposit. So what is the meaning of interest accrued? Interest yet to be paid. But this particular interest, it is already due. It is already due on saving and fixed deposit. So even though the customer has not withdrawn it, the bank owes it. So it is a kind of liability. And yes, it is included in the NDTL as other demand and time liability. Yes, in the section other demand and time liability, other DTL, this particular interest accrued is included. Right. Please remember. For example, let me give you one example to make it more clear. For example, suppose your FD earn rupees 500 interest. So, okay. So by quarter end your FD earn rupees 500 interest. Right. So the bank has to pay you. So it is recorded as a kind of liability. Fine. Now let's look at option number B. That is borrowing from RBI and refinance from NABARD, Exim, etc. So this is the correct answer because it is not included in NDTL. It is not included in the NDTL. Why? Because these are the kind of loans that bank take from another institutions like RBI, like NABARD. These are kind of loan that bank take from RBI, NABARD, Exim Bank. But remember, NDTL include liability to the public and other bank. Try to understand what I'm telling you, that this particular NDTL, it includes what? Liability to the public, right? Liability to the public and other bank, not from the institution like RBI. Yes, these are loans from RBI, NABARD, Exim Bank, but NDTL does not include such kind of loan. NDTL basically include liability to the public and other bank. So this is excluded. You can think of it like this. If I borrow from my boss, that is RBI, it is not a general liability to the public or other bank. So it stay out of NDTL. Then comes option number C. What is option number C? Option number C is a credit balance in current account. Right. So these are balance other bank keep with us. It is like one bank depositing money in another bank current account. So these are called liabilities to the banking system. Yes, it is a kind of liabilities to the banking system. And yes, they are included in NDTL. Even though it is not the public money, yes, it is still a liability. So bank adjust it with asset held in another bank and take the net value while calculating the NDTL. What bank do? Bank adjust it, right, with the asset held in the other bank. Obviously, a bank A will have some asset held in the bank B. So adjustment is done. And that is why this particular thing is excluded, right, while calculating NDTL. Means that in short we can say it is included after netting off. Yes, after netting off we include it. Option number D say liabilities arising from interest-free court receiver deposit. See, this is a kind of a special case. This is a kind of a special case. These are, court ordered deposit. Like when a case is pending. Suppose a particular case is pending, right? Like when a case is pending and the money is kept with a bank interest free. So case is pending, money is kept with the bank interest free. Since it is not money that bank can freely use, it is not considered a regular liability. So it is excluded from the NDTL. Because it is not the money that bank can freely use. Okay. So it is excluded from NDTL. But wait, this is the tricky part. Although it is excluded, the question asks for what is not included, and option B is a better match because it is clearly and completely excluded. So the final answer is option number B, right? So let's summarize what we have learned in this particular question. That what is NDTL? I told you NDTL means how much money bank ought to the public and other bank in form of saving, current and fixed deposit. So in short, if we talk about NDTL, is how much money the bank ought to the public. Right, how much money bank ought to the public, that is called NDTL, right, in the form of saving account, in the form of current account, in the form of fixed deposit account. So basically this NDTL help RBI decide how much money bank must keep as CRR as well as the SLR. And what are included in NDTL, remember it, very important. So first of all, I told you interest accrued, that means interest payable on deposit, yes, it is included. Then current account balance of other bank, right, this is included. But what is excluded? Borrowing from RBI, borrowing from NABARD, borrowing from Exim Bank, these are excluded. And there are some special cases like court receiver fund, these are excluded, right? Hope that this breakdown make it super clear. Friend, if you are looking for a study material for CTP, that is Certified Treasury Professional Course, in the form of PDF, in the form of unit-wise MCQs, in the form of previous year question, you can enroll in our course. The detail of the course is provided in the description section. Many aspirants have cracked the examination by going through the course. You can also easily crack the examination. For more detail, you can WhatsApp me on this particular number. Now friends, have a look at the question number 3. So the question number 3 is on your screen. It is also one numerical based question, very important from examination point of view. Have a look. So friends, what is the question? You are analyzing a 3-year corporate bond with face value of 100 rupees, offering annual coupon rate of 12%, prevailing YTM is 8%, bond is trading as 110.50. What is Macaulay duration in year of the given bond? Yes. So what is in simple term, when we talk about this Macaulay duration, it simply means, average time it takes to recover the bond price from its cash flow. I'm again repeating, average time it takes to recover the bond price. How much time it takes to recover the bond price from its cash flow, right? So that is called Macaulay duration. So basically, it consider both the timing, it consider both the size of each payment. Yes, timing is also considered and size is also considered. Now, as you can see here, that this particular bond is paid semi-annually. You can see this word written here, semi-annually, right? So what is the meaning of this term semi-annually? You know it very well. Twice a year, right? So basically, since this bond pays semi-annual coupon, that means 2 payment per year for 3 years. So can you tell me how many period will be there? See, in every year, 2 period, right? So total is a three year. So it will be 6 period in total, right? Total it will be 6 period. Now let's calculate step by step. First of all, calculate the coupon amount. What is the coupon per period? What is the coupon amount per period? As you can see, it is 6%, I think. It is 12% annual. So semi-annual it will be 6%. Okay, so 6% coupon of the face value. What is face value? 100 rupees. What is 6% of 100 rupees? It is rupees 6. Right? Because 12 rupees it paid every year, but every half year, our period is half year. So every half year, you can see YTM is given 8%, but this 8% is annual. So what will be the YTM for 6 months? It will be 8 by 2, which is equal to 4%. Now have a look at the cash flow. So for cash flow, what we will do? We will create a particular table. This tabular method is the most preferred one for computing this, macro-duration. So first we will write period, then we will write the cash flow, then we will write PV at the rate 4%, and then we will write PV multiplied by TI. Okay, PV multiplied by time. Now, so basically these are the columns that we have: period, cash flow, PV means present value at the rate 4%. Now, so we have 6 period. 1, let me write down. 2, this is 3rd, this is 4th, this is 5, and this is 6. Okay. Now, what are the cash flow? Coupon amount 6 rupees, 6 rupees, 6 rupees, 6 rupees, 6 rupees, and finally you will receive 6 rupees along with the face value, which is equal to 106. So these are the cash flow. Now we want to calculate this is present value factor, right? So what is the present value? How to calculate the present value? So basically to calculate the present value, how do we do it? So future value upon 1 plus r whole to the power n. So for the first case we will write n is equal to 1. So it is nothing but 6 divided by 1 plus 0.04, which is equal to 5.77. In the second case, it is equal to 6 divided by 1.04 ka square, right, which is equal to 5.55. In the third case, 6 divided by 1.04 ka cube, which is equal to 5.34. 6 divided by 1.04 to the power 4, which is equal to 5.13. 6 divided by 1.04 to the power 5, which is equal to 4.93. And finally, in the last case, 106 divided by 1.04 to the power 6, which is equal to 83.78. Right. So these are the present value. Now in the last column, what we will do? We will multiply the present value with the time. So what is the time? This period I am talking about. So first of all, in the first row, it will be 5.77 multiplied by 1. Right. Which is equal to how much? 5.77. In the second row, it will be 5.55, this one, multiplied by this one. Okay, so this will give us how much? This will give us 11.10. In the third row, this will be 5.34 multiplied by 3, which will give us 16.02. Similarly, 5.13 multiplied by 4, which is equal to 20.52. 4.93 multiplied by 5, which is equal to 24.65. And finally, 83.78 multiplied by 6, which is equal to 502.68. So now as you can see, total present value, if you add all this value, 5.55, 5.34, 5.13, if you add all of this, you will get how much? You will get total present value as 110.50. This is the total present value, or we call it summation of PV. And if we calculate summation of PV into T, so this will give us, if you add all of them, you will get how much? 580.74. Now let's apply these two in the macro-duration formula. So what will be the macro-duration? Summation of PV into T upon summation of PV, which is equal to 580.74 upon 110.50. Okay, so the answer will be how much? 2.63. This will be the macro-duration. So option number B will be correct. 2.63 will be correct. Right. I hope that makes sense to you. Now let's summarize the point we have covered in this particular slide. What I told you, that macro-duration is a kind of average time. Right. This is a kind of average time to recover the bond price. You have to recover the bond price. Average time it takes to recover the bond price is called macro-duration. And it uses present value of each cash flow multiplied by time. Semi-annual coupon bond means you have more frequent payment, reducing the duration. And always remember, always divide PV into time by the price. Okay. So if the payment are semi-annual, convert period into year at the end. Right. So I hope that makes sense. I have explained each and every option, each and every step, how to go about calculating the duration. Now friend, let's look at the second part of this particular question. The question is, if yield increases, what happened to the bond duration? Very good question. Duration increase, duration decrease, duration remain unchanged, and duration become 0. First of all, let's understand what is the meaning of this duration in the simple word. I told you now that duration is the kind of average time. Average time it takes for a bond holder. Suppose there is a bond holder, how much time it will take for a bond holder to recover the money? Because bond holder have invested the money, right? So how much time it will take to recover the money, right, that they have invested in the bond? So it is not just about time. It's also about, value of future payment. It's also about value of what? Future payment. It is not just about time. Now the question is, what happened when the yield increase? As you can see, yield is increasing. The question is, what will happen when the yield increase? So as you can see, if yield will increase, then discount rate will decrease. And what will happen if discount rate will decrease? What will happen? Those future payment will get discounted more heavily. They get discounted heavily. The future payment will get discounted heavily. That means, for further payment lose more value compared to the nearer one. So it simply means, further payment will lose value instead of the compared to the nearer one. So the weight shift toward earlier payment. Weight shift toward earlier payment, right? And since weight shift toward earlier payment, so what happened? Your duration becomes short, right? Your duration becomes short or duration decreases, right? Let's go through each and every option. Option number A say duration increase. Wrong. It is wrong. Why? Because if the yield increase, future cash flow are worth less today. Duration actually fall because we recover value faster. Because as you can see, yield increasing, discount rate decreasing, future payment get discounted heavily, further payment lose value, weight shift toward earlier payment, and duration decreases. Now option number B say duration decrease. Exactly. Because higher yield means lower present value of the long-term payment, shorter average time to recover payment, and duration goes down. Let me give you one example to make it more clear. Suppose you lend rupees 100 and you expect rupees 50 next year. You expect rupees 50 next year. You have lent rupees 100 and you expect rupees 50 next year, and rupees 50 you are expecting after 5 years. In the next year you are expecting 50 rupees and 50 rupees you are expecting after 5 years. Now in this case, suppose interest rate increases. So what will happen? That 50 rupees in the 5 year is worth much less now. So most of your value is recovered today. So obviously your duration will get lower. Why it is worthless? Because if you calculate the present value, it is future value upon 1 plus r whole to the power n, right? So if interest rate is increasing, this one is increasing, so this is decreasing, so present value is decreasing, so the worth of this 50 rupees is very less. So what happened? The duration shift toward the earlier value. That's why the duration of the bond decreases. Means you can recover the amount early, right? So that's why option number B is the correct answer here. What about which of the following correctly describe its formula? So 4 formula are given here. Option A is portfolio return minus market return divided by beta. Option B is portfolio return minus risk-free return divided by standard deviation of the portfolio return. Option C is portfolio return minus risk-free rate multiplied by standard deviation of the portfolio return. Option D is portfolio return minus benchmark return divided by standard deviation of the benchmark return. So these are the 4 options. So friends, you can think of the Sharpe ratio as a way to measure how much return you are earning for every unit of risk, right? For every unit of risk, right? How much return you are earning. That is called Sharpe ratio. Basically, it compare your portfolio return to risk-free investment. So what are risk-free investment? What are the example of risk-free investment? So like, government bond. Government bond is a kind of risk-free investment. So basically what you do, it compare, on one side you have your portfolio return and the other side you have your risk-free investment. Okay, so both comparison is being done, portfolio return versus risk-free investment. And then after comparing, it divide it by how much your portfolio fluctuate. That is called a standard deviation. So now the formula for Sharpe ratio is very simple. You write the return, subtract it with the risk-free rate, and you divide it by the standard deviation of return. You divide it by the standard deviation of the return. So basically you are getting extra return per unit of total risk. So let's break down each and every option. First of all, let's look at option number A. It says portfolio return minus market rate divided by beta. It is wrong formula because this is actually for trainer ratio. This formula is actually for trainer ratio, not Sharpe ratio. It use beta. Trainer use beta, which only consider market risk, but Sharpe use total risk. What about option B? Option B say portfolio return minus risk-free rate divided by standard deviation of the portfolio return. Yes, it is the perfect formula. Because this is the exact formula for the Sharpe ratio, you take the extra return over safe investment and divide it by the volatility of the portfolio. Right? So what you do here, that you take the extra return over the safe investment. So this is your safe investment and this is the extra return you are getting. You take the extra, means you define the difference. So this is the extra value, right? And you divide the extra return by the volatility of the portfolio, and volatility is measured by the standard deviation. So suppose, let me give you one example. Suppose your portfolio give 10% and suppose risk-free rate is 5%. Okay, and the standard deviation is suppose 2%. So what is the Sharpe ratio? Sharpe ratio is 10%, which is your return. 10% is your return. Then you subtract risk-free rate, which is 5%. 10% minus 5%, and you divide it by the standard deviation, which is 2%. So which is equal to 2.5. So which means 2.5 unit of return per unit of risk. So basically in the numerator we have return only. In the denominator we have, risk. Right. So basically 2.5 unit of return per unit of risk. So this is the option. Option number B is the correct answer. What about option C? This they have multiplied it. Instead of dividing, they have multiplied. So it is quite incorrect. Option D is also incorrect. So what we learned from this discussion is that, this particular Sharpe ratio, it tells you how efficiently your investment give return for the risk you are taking. Means how efficiently your investment is giving return for the risk you are taking. It uses risk-free rate, okay, as baseline. It measures the total risk. It measures the total risk using the standard deviation. How do we calculate it? We write the portfolio return. We write the portfolio return. We subtract the risk-free rate and we divide it by the standard deviation of the portfolio. Right? So this will give us the Sharpe ratio. So remember, if the question asks about Sharpe, you always look for risk-free rate and standard deviation. If you see beta that is basically for trainer ratio. Now friends, have a look at the next question. So the next question is another based on commercial paper CP. So question is ABC Limited and reputed Indian corporate with net worth of 200 crore. They plan to raise short-term working capital via the issue of commercial paper. Okay. The company already has a standard fund-based facility from a leading public sector bank. ABC Limited has a credit rating of A3 and they want to issue CP worth 10 crore with maturity of 90 days in demat form. They appoint a scheduled bank as the issuing and paying agent, that is IPA. After 40 days, ABC Limited wishes to buy back the CP from the investor. So basically every aspect has been taken care of in this particular scenario. Right. So basically, they have a net worth of 200 crore. Right. They want to raise money via CP, and they have a standard credit rating of A3. They want to issue CP worth 10 crore, maturity 90 days, demat form. Okay. They have appointed IPA. After 40 days, they wish to buy back the CP. Now the question is, which of the following conditions make ABC Limited eligible to use CP? Option A, net worth of 50 crore and a bank loan under default. Option B, net worth of 200 crore and a standard fund based facility. Option C, credit rating below A3. Option D, no working capital sanction from any bank. So basically if we talk about this CP, which is a commercial paper. So commercial paper is short term IOU. It is a kind of short term IOU. Basically who issue it? Company issue it. Right? To borrow money. Why company issue it? Company issue it to borrow money for a few months. Usually up to 1 year. Usually up to 1 year without giving a collateral. But because it is unsecured, yes, it is unsecured. Because it is unsecured, only company with a strong financial can issue it. There are some eligibility criteria. So minimum credit rating is A3, right? or better. Minimum credit rating is A3 or better. And first point. Second point is they must have a standard fund-based facility. This is very much required. A standard fund-based facility. Right, it is required from a bank. And the third point is, suppose it is corporate, suppose it is LLP, or suppose it is a trust, corporate, LLP or trust. So net worth must be 100 crore or more. So these are the three conditions which make ABC Limited eligible to issue CP. First of all, credit rating of A3 or more. Second point, standard non-default fund-based facility from a bank. And for corporate, LLP and trust, net worth must be 100 crore or more. So let's look at the option. Option is a net worth of 50 crore. No, RBI require minimum 100 crore as net worth. 50 crore is too low. And if the bank loan is under default, the company is clearly not financially healthy. What about option B? Net worth of 200 crore and standard fund-based facility. It is perfect because ABC Limited has 200 crore net worth, a standard bank facility, credit rating of A3. So all eligibility box are ticked. So yes, this is a criteria. Credit rating below A3, they are ineligible because A3 is the minimum accepting criteria. A3 is the minimum accepted criteria. Anything below A3 like B or C, it means high risk. And then we have option D, no working capital sanction from any bank. This means company has no verified credit track record. Company has no verified credit track record. So RBI want company to have an existing fund-based limit. It shows the bank has checked them, so this condition also failed. So let's summarize the point. First of all, what we talked about is the CP is a kind of short-term borrowing tool for financially sound company. And I told you the eligibility rule. The first one is that its net worth must be greater than or equal to 100 crore. Second point is that its credit rating must be more than A3. Third point is that it should have a standard bank fund-based facility. It should have a standard fund-based facility. Okay, so remember, if a company want to issue CP, it must be financially strong, not just big. Now friends, have a look at the next question. So the next question is, this question is also related to the same case study. It is asking you, what is the minimum maturity and the form of issuance required for ABC Limited CP? CP means commercial paper. Option A 30 days physical certificate, 15 days demat form, 7 days demat form, 1 day physical certificate. So I told you this CP is a commercial paper. It is a kind of short-term borrowing tool used by company to raise money quickly. It is usually used for working capital need. And it is unsecured. It is quite unsecured, meaning no collateral, and it is issued at a discount for a fixed maturity. And as per RBI guideline, the minimum maturity for CP is 7 days, and the maximum maturity is 1 year, right? So, and one more thing is that CP is issued in demat form. CP is issued in demat form. Demat means electronic form, especially since bank can only invest in demat CP. Now let's look at the option. Option A says that 30 days physical certificate. So 30 days within the allowed range, but there is a problem that physical certificate are not the norm anymore, right? CP are issued in demat form only. Option B say 15 days and demat form. Yes, it is correct. Demat form is correct, but minimum maturity should be 7 days, not 15 days, right? So option C, yes, option B is also not the correct one because demat form is correct. Option C is 7 and demat form. Yes, this is the absolutely correct answer. This is the perfect answer. Minimum maturity, just told you 7 days, and demat form, yes, this is very much important. So what we learned from this discussion is that commercial paper is a short-term money tool for a company. Minimum maturity, I told you, it is just 7 days, and it is issued in demat form only, right? Bank can invest in CP only in demat form. So the final answer is option number C. Now friends, have a look at another question based on the same discussion. ABC Limited buy back the CP 40 days after issuance. Which of the following is true? Option A, that this buyback is allowed as minimum 30 days have passed. Option B, buyback is invalid as CP cannot be repurchased. Option C, buyback must be done at face value only. Option D, buyback must be done on 90th date only. So tell me, so ABC Limited buy back the CP 40 days after issuance. So which one is correct? Let's first understand, can a company buy back it on CP? This is the question. Can you buy back on CP? Can you buy back on CP? See, the answer is yes.
Yes, company can buy back their own commercial paper before maturity, but only under certain condition. The condition is that the commercial paper must be at least 30 days old. The commercial paper must be at least 30 days old, right? And the buyback should happen through the secondary market. This is another condition, that buyback should happen through secondary market, not privately. It should not happen privately. So these two conditions must be fulfilled. First one I told you, it should be 30 days old. CP must be at least 30 days old. And the second condition is that buyback must happen through the secondary market. It should not happen through privately. Now, as per the RBI rule, you must remember that buyback of CP is allowed through secondary market only. First point. It must be done after 30 days from the issue date. And it is always done at the market price. It is always done as the market price, not necessarily at the face value. Now, in this case, what we are observing is that CP was issued for 90 days, right? CP was issued for 90 days. As you can see in this particular question, let me come back to this particular question. Let me show you that here you can see that CP was issued for 90 days. As you can see, maturity is 90 days. And ABC Limited want to buy back on day 40. Yes, ABC Limited want to buy back the CP from investor on day 40. Since 40 is larger than 30, so the buyback is valid. Because I told you, minimum 30 days, right? It must be done after 30 days from the issue date. After 30 days. And yes, it is being done after 40 days. So obviously it is valid. Before 30 days, it is not valid. Now, in this case, CP was issued for 90 days. ABC Limited want to buy it back on day 40. So obviously, let's go through each and every option. So option number A say, the buyback is allowed at the minimum 30 days have passed. Yes, this is correct. As per RBI guideline, buyback is only allowed after 30 days. Since 40 days have passed, this is absolutely valid. What about option B? Buyback is invalid as CP cannot be repurchased. What do you think about it? See, this is wrong. Why it is wrong? Because CP can be bought back, but through the secondary market and only after 30 days. So this statement is not correct. Because it is saying that buyback is invalid. No. Buyback is not invalid. Rather, it can be bought back. Option C say buyback must be done at the face value only. Totally wrong. Because CP is traded in it is talking about face value. See, CP, they are traded in the secondary market. They are traded in the secondary market, right? And the price constantly fluctuate. So buyback always happen at the market price. Remember, buyback always happen at the market price, not face value. Then option number D say buyback must be done on the 90th day only. This is also wrong. Totally wrong. Because CP is mature on the 90th day, but company are allowed to buy it back before, as long as 30 days have passed. So the day 40 is fine. So let's summarize what we learned from this particular question, because learning is very much essential. I told you that CP can be bought back by the issuing company. Yes, issuing company can buy back the CP. This is the first point I told you. Second point I told you that buyback must happen after 30 days. Third point I told you, the buyback is done through the secondary market. Remember, buyback is done through the secondary market and it is done at the market price. So someone asks you whether buyback is possible at the face value. No, remember, buyback is not possible at the face value. And the fourth point is I told you, no need to wait until maturity. No need to wait till maturity. You need not wait till maturity, right? So I told you in this particular case, since 40 days have passed, so buyback is allowed. So the key takeaway is that the buyback of CP is allowed, but not too early. Wait 30 days and then go to the market. Simple. I hope that makes sense, right? Now the last question of this particular case study is that, as you can see, why might a bank choose to invest in ABC Bank CP? Option A, CP has high credit rating but long-term maturity. CP is risk-free and interest-free. CP offer higher yield than interbank money market with short-term credit exposure. Option D, CP is a physical security with high liquidity. Now the very good question it is. Let's first understand what is CP. I told you it is a kind of short-term debt instrument issued by company to raise money quickly. And why bank prefer CP? Because it offer better return. CP, CP offer you better return. It offer you better yield as compared to call money, as compared to overnight lending. So if you compare to call money, if you compare to overnight lending, this CP is offer better yield. And the credit risk is short term. Yes, the credit risk, of this CP is very short term. Okay. And it is a kind of tradable instrument. So there is a good liquidity. Let's go through each and every option. If you go through the option number A, it says that CP has high credit risk but long-term maturity. It is completely wrong. Why? Because CP actually has low to moderate credit risk. And you know, it is a kind of short-term instrument. It is usually 7 to 365 days. So this statement is incorrect. Option B say it is risk-free and interest-free. It is again wrong. CP is not risk-free. Though it is issued by top-rated company, there is still some credit risk. Also, it is not interest-free. It is issued at discount and redeemed at face value. So investor earn interest indirectly. Option C say it offer higher yield than interbank money market with short-term credit exposure. Try to understand. CP usually give better return than call money or interbank lending. And since CP mature in a few weeks or month, the credit exposure is short-term, which reduces the risk. Let me give you one example. For example, suppose that interbank call money rate. Suppose interbank call money rate is 5% and suppose CP is offering you 6.5%. So the bank earn more, right? So the bank is earning more. Bank is earning more by investing in CP with only 90 days exposure. And option D say CP is physical security with high liquidity. This is partially wrong. Yes, CP has high liquidity, but it is not a physical certificate anymore. I told you already, it is always issued in the form of demat form. So let's summarize the point which we have just covered. First of all, why bank invest in CP? Because it offers higher yield than short-term bank-to-bank lending. And you know, credit risk is low, right? And it is only for short time, limited to short period. And you know, CP are quite tradable, right? So bank can sell them before maturity if needed. And CP is always issued in, you know, demat form. So option C is the correct answer. Now friends, have a look at this question. You know, from bond, many questions they are asking, right? In this question, they have provided you the data, like, you know, face value, they have given 1000 rupees. Coupon rate, they have given 12%. And it is paid semi-annually. And you know, 3-year maturity is there, right? And the required rate of return is 10%. So they have asked you to calculate the value of the bond. So friends, how to calculate the value of the bond? First of all, what is the face value? Face value of 1000. What is the coupon rate? Coupon rate is 12% annually. So which means 6% every 6 months or every bi-yearly. So what will be the coupon payment? If you calculate the coupon, it will be 1000 multiplied by 6%. Okay, that will be how much? 60 rupees every 6 months. Now what is the maturity? If you look at the maturity, I think it is 6 year, but it is 3 years, sorry. It is 3 year. So it is 3 year. How many periods are there? 3 multiplied by 2. So there are 6 periods. Okay, 6 half-year period. And what is the required rate of return? What is required ROR? So required ROR, as you can see, is 10%. Required ROR is 10% and that is per annum. And we want to calculate it after 6 months. So it will be 5% every 6 months. So everything you have to compute 6 month basis. Now we will use the present value formula. So you know, bond value it can be categorized into 2 parts. First of all, what do? You calculate the present value of coupon payment, all coupon payment plus, that is called annuity. So in that case, you apply the annuity formula to calculate the present value of all the coupon payment. And then you calculate the present value of the final principal amount. You calculate the present value of the final principal amount. That is called lump sum. That is called lump sum. So now in the question, they will provide you present value interest rate factor. So let me give you, so they will give you PVIFA. That is called, you know, present value interest rate factor. Please remember. So PVIFA 5% for 6 month coupon is, they have given you 5.0746. This data will be given in the question. Don't worry about that. And PVIFA for 5% interest at 6% at 6 month coupon, they have given you, try to understand, this is PVIF, present value interest rate factor, and present value interest rate factor annuity. So these are two different. So they have given you 0.746. Now this data is available. So what we will do to calculate so we will calculate separately. Let's calculate the present value of coupon. How do we do that? So multiply this 60 rupees with 5.0746. Okay. So with the PVIFA, how much you will get? So you will get 304.
0.48. 30.4.48. So this is the PV value of the coupon. And what is the PV value of the principal? What is the PV value of the principal? So that is nothing but 1000 rupees multiplied by 0.746, which is nothing but 746 rupees. So the total value of the bond, total value will be the sum of these two, which is 304.48 plus 746. And if we add both of them, we will get 1050.48. Right? If you go through the option, so nearest option is option number B, and yes, it is the correct answer. So friends, remember, let's summarize what we learned from this question. You know that bond pay rupees 60 every 6 months for 3 years. What we do, we discount those cash flow using the required return. And what is the required return? Required return is 5% per period. We add the present value of all the coupon payment and we add the present value of the face value. And we use this PVIFA and use this PVIF from the standard table. There is a standard table and in the examination they provide you the data. And remember, if the coupon rate is larger than the required rate, so bond always trade above par. And you can see bond is trading at 1050 rupees. So remember, if the coupon is more than the required rate, the bond price goes above rupees 1000. Right. So friends, I hope this concept is clear now. Now friends, if you really think that this video is adding values to your preparation, please hit that like button. This will encourage me to make more such and such content. Right. Now friends, have a look at the next question. The next question that we have is related to Mr. Raj. Mr. Raj is a corporate treasurer. He is managing a 10 crore floating rate loan, right, which is linked to 6-month LIBOR. He is concerned that interest rate may rise above 7%, which could increase his interest expense significantly. Right. So he feared that interest rate may rise above 7%. So what he did, he buy a interest rate, cap with a strike rate of 7%. One of his settlement period sold LIBOR at the LIBOR at 8.5%. Okay. Now as you can see, one of the settlement periods saw the LIBOR at 8.5%. Now the question is, what is the main purpose of the Mr. Raj buying an interest rate cap? Option A, to benefit from falling interest rate. Option B, to protect against interest rate falling below 7%. Option C, to reduce loan principal. Option D, to hedge against the rising interest rate above 7%. This is a very good question. Now the question is, what is the meaning of this interest rate cap? See, this is like, insurance policy. This is like, insurance policy for whom? This is insurance policy for borrower. Right. It set a maximum limit, and that maximum limit we call the strike rate. That maximum limit we call the strike rate on how much interest they have to pay on a floating rate loan. So they set a maximum limit on how much interest they have to pay on the floating rate loan. In this case, as you can see, Mr. Raj, he has 10 crore loan. Mr. Raj has 10 crore loan. It is linked to 6-month LIBOR. It is linked to 6-month LIBOR. And suppose LIBOR rises above 7%. If LIBOR rises above 7%, so the cap kicks in. Cap kicks in. Right, because they have set the cap at how much? They have, as you can see, they have set the cap at 7%. Yes. So if the LIBOR increases 7%, cap will kick in. Right. So he will only pay up to 7%, and the difference, suppose the rate as you can see is 8.5%. So what is the difference? 8.5 minus 7%, which is how much? 1.5%. So this 1.5% is paid by the cap seller. This will be paid by the cap seller. Right. So that is the point. Now let's go through each and every option. Option A, to benefit from falling interest rate. See, cap don't help with the falling interest rate. See, if the interest rate fall, right, Raj pay lower interest anyway. That is the benefit of a floating rate loan. The cap only help when the interest rate rise. Option B, to protect against interest rate falling below 7%. This is again wrong. That sound more like a floor, not a cap. Cap help when the rate go above a certain level. Floor help protect the minimum interest income, which is not the case here. To reduce loan principal. Again, it is completely incorrect. Interest rate cap has nothing to do with principal. They only manage the interest payment risk. Option D say to hedge against rising interest rate above 7%. Yes, this is the perfect. That is exactly why Raj bought the cap.
he is afraid that LIBOR will go above 7%, which means higher interest outflow. So the cap makes sure that his cost does not rise beyond 7%, no matter what LIBOR does. So let's summarize what we come to know in this particular question. So friends, I told you that we talked about interest rate cap. It is a kind of ceiling. Let's summarize. Interest rate cap is a kind of ceiling on how a high interest rate payment can goes up. In the case of Mr. Raj, you can see he has a floating rate loan. Interest rate move with the LIBOR. He want to avoid paying more than 7%. So he buy a cap at 7%. If the LIBOR go to 8.5%, he still pay only 7% and the cap seller pay the rest. Now, the question is, how much Mr. Raj received from the cap in the settlement period when LIBOR rises to 8.5%? Very good question. Right. So friends, let's understand the concept first. When LIBOR rises above the cap rate, and the cap rate is how much? 7%. Right. So Mr. Raj get a payout from the cap seller. Yes, he will get a payout from the cap seller. This compensate him for the extra interest he would otherwise have to pay on his loan. And if you want to calculate the cap payment, this question is most frequently asked. Remember the formula. Just take the notional value, just multiply it by the LIBOR minus the cap rate, just multiply it by days and divide it by 360. Because days to convert into year, we multiply it by 360. Now let's plug in the value. What is the notional value? 10 crore. 10 crore is the notional value. What is the LIBOR rate? So LIBOR rate has risen to 8.5%. What is the cap rate? Cap rate is 7%. So this is nothing but 0.085. This is nothing but 0.07. Now let's apply the formula. So 10 crore, 10. Instead we will get 9 rupees as interest, because if you find 9% of 100, you will get 9 rupees. So this is the step number 1, means what the bond give you. So the bond give you rupees 9 as interest. Second thing is how much investor get paid. How much investor get paid. This thing you have to look upon. So you know the bond was bought at rupees. It was purchased as rupees 105. It was not purchased on rupees 100, right? The bond was bought. The bond was bought at rupees 105, right? So this is the point. Now, if we apply the current yield formula, if you remember the current yield formula, right, it is very easy to understand. So basically what you do in the case of finding the current yield or CY, you write the annual coupon in the numerator. Okay. And in the denominator what you write? You write the purchase price. Annual coupon divided by purchase price multiplied by 100. So what is the annual coupon that you have? So annual coupon is 9 rupees. And what is the purchase price? You bought it at 105, multiplied by 100. So you tell me, 9 is how much percentage of 10.105? So that is nothing but 8.57%. So the correct answer is option number B, right? So even though, try to understand, even though the bond is paying 9 rupees per year, but the return based on what the investor actually paid, which is 105, is only 8.57%. So remember, whenever we find the current yield, we see that at what price the bond was purchased. If we don't see the face value, rather we see the market price of the bond. We compare it with the market price of the bond. That is the crux of this particular question, and we get 8.57%. Now friends, let us go through each and every option. Option A say 9.45%. This would be correct if the interest was higher or the price was lower, obviously, right? Not applicable here. 8.57% is the clear answer. So let me give you one example to make this concept more clear so that you can remember the formula for lifetime. Imagine that you buy a juice bottle. Suppose you buy a juice bottle worth rupees 100. This is the MRP. 100 is the MRP, and you buy the juice bottle, but you pay rupees 105 for it, right? You paid rupees 105. So you still get the same juice. That is 9 rupees coupon. Here juice is the coupon, right? You still get the 9 rupees coupon, but your cost is higher. So your return is bit lower than expected. So you expected obviously 9% return, but since you paid larger, so your return will be 8.57%, which is lower than the expected return. So that is what coupon yield is all about. So what we learned from this question is that, so first of all you must understand what is coupon. Coupon is the fixed percentage on face value. Coupon is the fixed percentage on face value. This is the first point. Second point we talked about is the current yield. What is the current yield? This is the return. Current yield is the return based on purchase price. Now one more thing, if you buy above face value, right? If you buy above face value, what will happen? Your current yield will go down. As you can see, in this case, current yield go down to 8.57% because you buy above face value. And what is the formula for current yield? It is quite simple. In the numerator, you write the coupon. In the denominator, you write the price you have paid and multiply it by 100. So that is the formula for current yield. And you should ignore any kind of capital gain or capital loss or maturity value. So that is how you calculate the current yield on bond in the simplest way. I hope it is clear now. Now if any question is asked related to current yield, you can easily answer. Now friends, have a look at the second question, which is based on the treasury function. Right, I have also bifurcated the topic name for your easy understanding. You can understand that yes, this topic is super important because questions are most frequently being asked based on them. So the question is, which of the following correctly match the role of front office, middle office, back office in the treasury function? Right, so you can see options are given. Function, you should know the function of these all these office: front, middle, back. So what are their function? So have a look at the option. Option number A say front office validate and settle deal, middle office execute transaction, and back office manage funding and liquidity. B say front office handle funding, risk and liquidity management, middle office support deal validation, and back office execute market transaction. C say front office execute and analyze funding, cash and risk, middle office handle reporting and analysis, and back office validate, settle and account for deal. And D say front office handle internal audit, middle office only deal with IT infrastructure, and back office analyze trading pattern and market risk. So these are the options which has been given to you. So now friends, let's break down what each office does using a simple analogy. Okay, I will give you a simple analogy so that you can remember it for the lifetime. So first of all, let's start with the front office. So you can call them as, you know, director. Imagine a movie production. You take the example of a movie production. Okay, so suppose movie is being produced. So director and the actor, they are the front office. So they are the one in the action. Basically they are doing deal. They are doing deals. Okay, they are managing the risk. They are in action. They are doing deal. They are managing risk. They are handling the cash flow. Yes, they are handling the cash flow. So basically what they do, they make the real-time decision. Let me write it down. They make the real-time decision in the market. Who? Front office. Okay, so we are currently producing a movie. Just try to imitate it. Now, after that comes middle office. Now, who are the middle office? Middle office are the analyst and the planner. In the movie production, in terms of movie production, you can think of them analyst and the planner. They are the analyst. They are the planner. So what they do? They monitor the performance. Right? They monitor performance of each and every cast crew. Right? They check the risk. They create report. Yes, risk checking is also their part. Okay. See, here we also managing risk, but here checking the risk. Right? And then creating the report creation they have to do. Also they have to ensure that the deal made by the front office follow the rule. Whatever deal is made in the front office, they should follow the rule. So basically you can think of them as, you know, a strategy and control team. And the third team that we have is called, you know, back office. So the back office are, you know, administration team. You can call them as, you know, admin team. So they handle all the paperwork. All kind of paperwork are being handled by the back office. Any kind of confirmation that has to be given, any kind of settlement that has to be done, any kind of accounting work that has to be done, all are handled at the level of back office after the deal are done. Without them, no deal is complete. Now, I hope I have provided you the example, each and every function of each and every office. Now let's go through each and every option. First of all, if you look at the option number A, so it says that front office validate and settle deal. No, this is wrong. Front office does not handle validation and settlement. No, this is not handled by front office. That is the back office job. I told you now. Any kind of paperwork is being handled by the back office. So, and obviously middle office execute transaction. No, they don't execute transaction. And back office does not manage liquidity. So this is completely wrong. Okay. Option number B. Yes. In the case of option B, handle funding risk, and it is partially correct. Yes, front office role is partially correct. And back office, they are saying execute market transaction. No, that is wrong. Back office never execute market trade. That is a front office job. So option B is also wrong. If you go through option C, yes, this is completely correct, because front office, what they do, they execute and they manage risk and cash, right? That is the role of front office. In the case of middle office, I told you reporting and risk analysis is being done by the middle office, and back office, they confirm and settle the deal. You can see validate, settle and account for the deal. So yes, option number C is completely correct. What about option D? In option D, they say that they handle the internal audit. No, that is wrong. Front office does not do audit. You must remember that middle office is not only IT. It is written that middle office only deal with IT infrastructure. No, it is wrong. And back office does not do any kind of market analysis. That is the middle office territory. Any kind of market analysis is done by the middle office. So let me give you one real life example of it. For example, let's say a bank want to buy foreign currency for a client. So try to understand. Suppose a bank want to buy foreign currency for a client. Okay. So in this case, what will happen? This front office FO, what they will do? They will talk to client. They will talk to client. They will execute the currency trade. So trading will be executed by the front office. Executing trade. Okay. Now what middle office will do? Middle office will check if the deal is within the bank risk limit. There is a risk limit of the bank. So whether the deal is within the risk limit. And what the back office will do? Back office will confirm the deal. Back office will settle the money. Settlement is done here. And accounting work is done by the back office. So this is the clear bifurcation of the role performed by all these three offices. So what we learned from this discussion is that, the learning is that, whenever you see this word front office, just remember this front office, they are the deal maker. So let me write it down. So FO, they are the deal maker. Okay. They execute the trade. Trade execution is done. They manage the risk. Okay. And they manage the liquidity also. Then we talk about the middle office. So middle office, they are the controller. They ensure that the risk which is taken are within the limits. So they report, they monitor, and they help maintain check. Okay, that is middle office. And the last is the back office. Back office are the executors. Okay, so they handle confirmation, they handle settlement, and they handle the records. So in one word, if I say, if I just summarize this thing in one word, so you can say FO, they are in action, like in the movie. MO, they are monitoring. M for monitoring, you can think of them like that. And BO, they are the administration, admin. Okay, action, monitoring and admin. Just remember this word and the entire picture will come into in your front. That is how treasury team functioning in the bank or corporate setup. Friends, if you are preparing for CTP examination and if you are looking for a study material for CTP, that is Certified Treasury Professional course, you can install our app JIB and CIB Made Simple. I have created a course in which you can see two folders are there, previous year question. I have added one previous year question part 1. I am adding more and more, and also I have a separate folder for theory and MCQ PDF. If you go through this particular folder, you will see module wise content A, B, C, D, E, and inside each module, like you open module A, you will see unit wise content. And suppose you open the unit 1, you will see theory PDF and MCQ PDF. So theory PDF caters to all the important points written in the bullet format. As you can see, every point is written in the bullet format, and MCQs PDF cover the MCQs based on them. So this is a complete course on CTP, and this will help you to get a good marks in the examination of CTP. If you want to enroll in this particular course, what you can do, you can WhatsApp me on this particular number. So I am writing down the number here. So please, you can WhatsApp me and you can get detail how to access this course, or in the description section, you can check out the course link. You can directly click on the course link and can access it. So this is the WhatsApp number. You can WhatsApp me on this particular number. Now friends, I hope it is clear. Now let's go to the question number 3, which is based on option risk metric, that is the Greeks. Let's try to understand. Question is, which of the following statement about Greeks in the option trading is correct? Okay. Option A says that Greek represent the different country where options are traded. B says that Greeks are used to determine the final price of option contract. C says Greeks are mathematical measures used to assess different dimension of risk in option position. And D say Greeks refers to currency fluctuation affecting option in European market. So which option do you think is correct? First of all, let's understand what is the meaning of this Greek. Basically, what happened in the case of option trading, Greeks are not people or not countries. Rather, they are just risk indicator. In one word, I will say they are risk indicator. That's it. Okay, so they help the trader understand how sensitive their option is to different factor. Yes, so basically this is the option, how sensitive their option is to the different factor. Like what are the factor? Like price change, this is one factor. Like time left, this is another factor. Like interest rate, this is third factor. And market volatility, this is the fourth factor. So basically these are the factor, and this Greek tell you that how sensitive their option is to different factors. Okay, now let's go through each and every option. Option A say Greek represent country. No, that is completely incorrect. It might sound fancy but totally wrong. Greek are not about geography and nationality, it's just a name. Option B say that Greek determine the final price. No, this is wrong. Basically Greek tell you how much price might change when something else change. Okay, like if a stock price goes up or down. I told you these are the factors. So how the price will change, that is what Greek tell you. Option C say they are mathematical measure used to assess the different dimension of risk in option positioning. Yes, that is absolutely correct. Because the Greek help the option trader manage the risk. One word I will say, they help the option trader manage the risk. For example, delta. Have you heard the name of delta? So this delta show how much the option price will move. This delta is a kind of Greek. It shows how much the option price will move if the stock move by 1 rupees. Suppose a stock move by 1 rupees, how much the option price will move. That is what delta tell you, right? And another Greek is theta, right? These are the Greeks, you must know. Delta, theta. So what theta tells you? Theta shows how much value the option lose. How much value the option lose every day as it get closer to expiry, that is theta. Then we have vega. Vega? Vega is another kind of Greek. Vega shows how option price change with volatility. So it shows how option price gets affected with volatility. Vega. Then gamma. Gamma is another kind of Greeks. They show how delta change. How delta change. And finally we have rho. Rho means they show sensitivity to interest rate. So basically, and what about option number D? Let's look at option D. It says that Greek refers to currency fluctuation affecting option. No, that is wrong. Because it has nothing to do with European market or European country. So let me give you one example to make it more clear. Let's say you are driving a car. So car is just your option trading. You can treat the car as option trading. You are driving a car. You want to know how fast you are going. So that is your delta. How fast you are going, that is your delta. You want to know how fast your speed is changing. Speed is changing. How fast is your speed changing? So that is your, that is your gamma. Okay. You want to know how much fuel you are burning per hour. So that is your theta. You want to know how the wind affect speed. So wind affecting speed, your vega. And you want to know how much a change in fuel price would affect your trip cost. So that is your rho. So basically, these delta, rho, vega, gamma, theta, these are like Greeks. They don't drive the car, but tell you how your drive is reacting to different thing. So friends, let's summarize the fact. What we come to know from this particular discussion is that Greek. If we talk about the Greek, just remember this point, that Greek are the risk indicator. In one word, I will say Greek are the risk indicator. Okay. And second point is that they help the option trader understand that how time, how price, how volatility, right, how interest rate, they impact their option value. What are the impact of this factor on option value? That is what you can understand with Greek. And the most common Greek are delta, rho, gamma. These are the most common Greek. And theta. Okay, vega. And it is useful for risk management. It is not useful directly. So the next time someone say Greek in option, don't book a trip to Athens. Just think of risk tool for option trading. I hope that makes sense. Now friends, if you really think that this video is adding value to your preparation, please hit the like button. Next question is based on aggregate gap limit in spread. Have a look at it. So friends, question is, what does the aggregate gap limit in spread management primarily refers to? Option A, the maximum difference allowed between a bank asset and liability in a single currency over the day. Option B, the maximum cumulative mismatch in foreign currency position across all tenor, typically capped at a multiple of bank capital. Option C, a limit on the ratio of rate sensitive asset to rate sensitive liability in an interest rate gap analysis. Option D, the regulatory minimum liquidity ratio that bank must maintain based on demand deposit. So let's understand this using a simple scenario. Suppose a bank deal with foreign currency every day, right? Like suppose dollar, euro, and Japanese yen. These are the foreign currency. So basically they buy, they sell, they hold different currency over different time period. The time period may be 1 day, it may be 1 week, it may be 3 months. Okay. But what if the bank buy too much of a currency and does not sell enough? Yes. Suppose bank buy too much currency and does not sell it. What will happen? And or mismatch start building across different tenor. So that is where AGL aggregate gap limit comes into picture. Basically what it does, it controls the total currency mismatch. It control currency mismatch. AGL control the currency mismatch and the bank is allowed to take across all tenor. Let's see option number A. The maximum difference allowed between a bank asset and liability in a single currency over a day. So what do you think? Is it correct? It might sound okay, but it is too narrow. AGL is not just for 1 day. You can see over a day. No, it is not just for 1 day. Rather, it includes all the future period. It includes all the future period. I told 1 day, 1 week, 3 months, etc. etc. Option B say maximum cumulative mismatch in forex position across all tenor. So option A is wrong. Option B say yes, AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit. That is what AGL tells. AGL, that aggregate gap limit, tell the bank that you can't have a foreign exchange mismatch beyond a certain limit. And if we talk about this limit is set at 6 times the bank capital. This limit is set at 6 times bank capital. So this AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit. So suppose, let me give you one example to make this concept more clear. Suppose a bank has 1000 crore. A bank has 1000 crore in the capital. Suppose a bank has 1000 crore in the form of capital. So it cannot have FX mismatch. It cannot have FX mismatch beyond 6000 crore. That is the meaning of it. Okay. So that is what this FX mismatch tells you. That AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit, and this limit is set at 6 times the bank capital. So suppose bank has 1000 crore in capital, so it cannot have foreign exchange mismatch larger than the 6000 crore. What about, yes, option B is perfectly correct. What about option C? A limit on the ratio of rate sensitive asset to rate sensitive liability in interest rate gap analysis. This is wrong. Basically that is the part of interest rate risk analysis, not FX gap. Here we are dealing with foreign exchange gap. What about option D? The regulatory minimum liquidity ratio that bank must maintain based on demand deposit. Again this is wrong, because this is about liquidity management like SLR, CRR, not foreign exchange. Let me give you one example to make it more clear. So you can think of water tank. Right, water tank. So this is your FX portfolio. Your water tank is your FX portfolio. Okay. Now with multiple pipe. Suppose there are multiple pipes, and you can think of this pipe as time bucket. So this pipe are time bucket. So bringing in and taking out water. So the water you can think of like currency. So water tank, FX portfolio, foreign exchange portfolio, multiple pipes means time bucket, and water is currency. Now suppose more water comes in. Suppose more water comes in than goes out across multiple pipe. So tank of overflow. So that overflow is your foreign exchange mismatch. Suppose more water is coming in and less water is going out. And so what will happen? So obviously the tank will overflow, and that overflow is called foreign exchange mismatch. Okay, so this AGL, that is aggregate gap limit, is just like, you can think of this AGL as the height limit. You can think of them height limit. This height limit on how much extra water. Try to understand, very very important and easy to understand example I am taking you. So this height limit is tell you how much how much extra water means mismatch, how much mismatch is allowed in total across all pipe, how much extra water is allowed, that is what AGL tells you. Okay, so what we learned from this discussion is that, let us summarize the fact. I told you that AGL is the total allowed currency mismatch. Just remember, total allowed currency mismatch, okay, in foreign exchange across all time bucket. And I told you it is capped by RBI at 6 times total capital. Remember, it is capped by RBI at 6 times total capital. This is the second point. And I told you this help in managing the foreign exchange risk. Foreign exchange risk management, it help in managing, right, over the time, not just daily. Remember, it is done over the time, not daily. And it is used in treasury to prevent excessive foreign exchange exposure. So remember, AGL is your foreign exchange risk boundary. If the bank cross this boundary, it is like playing cricket without boundary rope. High risk and no control. I hope that makes sense to you. I have explained each and every option in the lucid manner. Now friends, have a look at the next question. So before solving this ATM ITM, let us move to the next question, that is based on NDTL. Yes, first of all solve this question. So this question is based on calculating the NDTL. A bank has the following figure in crore: demand liability, time liability, other demand and time liability, liability to other asset with the banking system. What is this NDTL? So let's understand this step by step. First of all, what is this NDTL? Net demand and time liability. Basically, it tells us how much money the bank has taken in from the public. How much money the bank has taken from public plus public and other after removing what it hold with other banks. Removing it holding with other bank. Okay, so how much money the bank has taken from the public and other after removing what it hold with the other bank. It is very important number, right? This NDTL is very important number, because using NDTL only you can calculate the CRR, you can calculate the SLR, you can calculate the liquidity as an LAF. So let's understand the step by step. What is the formula for NDTL? So NDTL, demand liability plus time liability plus other liability and time liability plus liability to other, right, minus asset with the banking system. This is the formula for NDTL. So what is the demand liability? We have 1500. What is time liability? 3000. What is other demand and time liability? 500. What is liability to other? 1000. And what is the asset with the banking system? 700. If you calculate it, this will give you 6000 minus 700, or we can call it 5300 crore. Right? 5300 crore is the correct answer. Option number A is the correct answer. Right? So imagine, so let me give you one example to make it more clear. Suppose a bank is there. It collect 6000 crore in various deposit. It collects 6000 crore in all types of deposit, demand liability, time liability, other liability. But 700 crore is what? 700 crore is just lying with other bank. It is just lying with other bank, this 700 crore, not with the customer. So in reality, the bank net liability to the public is just only how much? 5300 crore, not 6000 crore. That is what NDTL shows, the true liability after removing internal banking asset. Okay, that is what that's why we subtract asset with the banking system. So what we learned from this discussion is that whenever you are asked to calculate NDTL, just remember all external liability, because these deposits are the kind of liability for the bank, because it has to pay interest on that. That's why it is liability. So you add all external liability and you subtract the asset with banking system. Then this will give you NDTL. And this is quite useful technique for calculating CRR, SLR, LAF, liquidity, etc. And bank on deposit with other bank are excluded. I told you. Suppose there is a bank deposit with other banks, they are excluded. And this concept is very much important in monetary policy and regulatory compliance. So remember, whenever you see this NDTL in a banking system, remember, it is what the bank owes to the outside world after removing its own money parked with the other bank. I hope you have mastered the concept of NDTL using this explanation. Now friends, let's switch our focus to the swaption. What is swaption? So swaption or question is which of the following statement about swaption is correct? Option A. Swaption is a standardized exchange traded derivative, or we call it ETD contract similar to equity option. Option B. A payer swaption give the holder the right to receive a fixed rate and pay a floating rate. Option C. A receiver swaption allow the buyer to pay a fixed rate and receive a floating rate. Option D. A swaption is an over-the-counter option that give the buyer the right but not the obligation to enter into swap agreement. So friends, let's first understand what swaption is. So if we basically if we talk about the swaption, it is by combination of two words: swap plus option. Right? Swap plus option. It means basically what you are doing, you are buying an option. So why? Basically it is a combination of two words, swap and option. So let us understand what this swap and option is. So swap means you are buying an option. You are buying an option to enter into swap later. You will enter into swap later, right? And for that you are buying option. Is it clear? So you are buying option to enter into swap later, but only if you want to. There is no obligation. You have the right. You can enter into swap later. There is no obligation. You can think of it like, booking a movie ticket with a cancel anytime option. Suppose you are booking a movie ticket and you have the option to cancel it anytime. Okay. So, but you pay a little extra. That is the premium. Yes, you have paid a little extra. That is the premium. But if you don't want to watch the movie later, you are not forced to do. Similarly, with swaption, the buyer pay a premium to get the right, but not the obligation to enter into interest rate swap in the future. Because this is the characteristics of option. Option means you have the right but not the obligation. Okay, and you are paying for that a premium amount that you can enter into interest rate swap in the future. Because basically swap means IRS swap. Now let's go through each and every option. I think I have provided you sufficient information to you can easily answer it. Option A say that swaption is a standardized ETD contract similar to equity option. No. This is wrong. They are not traded on stock exchange. They are basically OTC. They are OTC, over the counter, which means can receive floating. So basically it is also wrong. Why it is wrong? Because receiver swaption gives the right to receive fixed and play floating. What about option D? Basically, swaption is an OTC option. OTC option means, it gives the right, not the obligation to enter a swap. This is the perfectly correct option. So basically, if we talk about, swaption, it is just like, privately agreed OTC option. Privately agreed OTC option to enter a swap. It is a privately agreed over the counter option to enter a swap. Okay. Where the buyer has full control to say yes or no on the swap start date. So let us give you an example to make it more clear. Let's say you are a company expecting interest rate to rise in next 3 months. Okay, you are expecting that interest rate will rise in the next 3 months. You are not sure yet, but you want to be ready. So what you do? Okay, you are not sure, but you want to be ready. So what you do? You will buy a payer swaption. You will buy a payer swaption. What will happen? Means you are paying a small premium today. Obviously, premium has to be paid. You are paying a premium that gives you the right to lock in the fixed rate later. If the rate goes up, you will exercise the option and protect yourself. And if the rate stays low, you will let it expire, no pressure. Right? That is a swaption. So let's summarize key point about swaption. What we have learned? Swaption is the option to enter into swap later. Swaption is the option that we can enter into swap later. So what happened? That buyer pays premium for the flexibility. Premium has to be paid. It is a kind of, OTC contract. It is a kind of OTC contract. They are not traded on exchange. And two types of swaption I told you. Payer swaption. Payer swaption means you pay fixed. You pay fixed and you receive floating. You pay fixed and you receive floating. And the second kind of swaption is, receiver swaption. So receiver swaption means you receive fixed and pay floating. Okay. So you can choose whether or not to enter the swap. So just remember, a swaption gives you the power to choose, not the obligation to act. It is a perfect tool for managing interest rate risk with flexibility. I hope that is clear to you. What is everything about swap option? Every aspect we have discussed regarding the swap option. Now, have a look at the next question. What best describe novation in the context of loan transfer? Novation, yes. So option A, it is a partial transfer of a loan where only the right, not obligation, are assigned to a third party. Option B, it refers to securitizing a loan by pooling it with other loan and issuing security. Option C, it involves the cancellation of the original agreement and substitution with the new one between the borrower and the new lender. Option D, it is a method by which the loan originator sells the loan without informing the borrower. So let's understand what novation means in very basic way. Basically, novation simply means, old agreement cancelled. Old agreement is cancelled and new agreement created. Old agreement cancelled, new one created between the borrower and lender. So old agreement cancelled, new created between borrower and the lender. So basically what happened, that the original lender step out of the deal completely and the new lender steps in with the borrower full knowledge and consent. It is like saying, hey borrower, I am not your lender anymore. Here is your new lender and you both will now sign a new agreement. So let's go through each and every option. Option A says that it is a partial transfer where only rights are assigned. What do you think about it? No, this is wrong. This is wrong. Why? Because this is a kind of assignment. This is a kind of, not novation, rather this is a kind of assignment, not novation. In assignment, what happened? The new party only get benefit. In assignment, the new party only get benefit, not responsibilities. Okay, that is, okay, so this is a kind of assignment, not novation. What about option B? This is another thing wrong, because this process is called, securitization. This is called securitization. That is completely different concept. It involves packaging loan and selling them as security. What about option C? Cancellation of the original agreement and signing new one. Yes, this is exactly right. This is what we call as novation. So basically what happened? The old is cancelled and the new is signed. Right? And the borrower agreed to this. This is what novation is all about. What about option D? Selling loan without informing borrower. So that may happen in the case of assignment. That may happen in the case of assignment, but not in novation. In novation, borrower consent is very much necessary. Okay, you can't, here is you can see the word without informing the borrower. This is completely wrong. You have to inform the borrower. Borrower consent is required. So let me give you one example to make it more clear. Imagine there is a bank A from which you took the loan. So from bank A you take the loan. After some time, this bank A want to exit and they want to introduce bank B, right, as your new lender. So bank A will cancel the old agreement and you now sign a fresh agreement with bank B with the same loan term or new one. So this is what we call novation. Okay. So this is a kind of clean handover with full agreement from all sides. So what we learned from this discussion is that, just let me summarize. Novation, whenever you see this word, this is a kind of new contract. This is a kind of new contract with new lender. We have a new contract with new lender. Okay. And original agreement is cancelled. Original agreement, what do we do? We cancel it. Okay. And what happened? Right plus obligation. Both right and obligation, they are transferred. Remember, right is also transferred, obligation is also transferred. And here, borrower consent is required. Borrower consent is needed. Okay. And it is opposite of assignment. This novation is, opposite of assignment. What happened in the case of assignment, where benefits are only transferred and original contract remain the same. So basically you can see that is a peculiarity of our session. We don't just discuss one question. We discuss multiple concepts related to that question, so that if any question appears in the upcoming examination, you can easily answer it. Right? And if you want such kind of video, such kind of PDF, you can enroll in our course. For more detail, you can WhatsApp me on this particular number. Now friends, look at the last question of today's session. Which of the following statement about forward rate agreement is correct? FRA is correct. Option A. And FRA is a stock trading contract executed on a stock exchange. FRA is a contract to buy or sell foreign exchange at future date at a fixed date. Option C. An FRA is the over-the-counter contract where parties agree today on an interest rate to be paid in the future. Option D. FRA allow party to exchange fixed interest payment for floating payment over the life of the loan. So these are the four options. Now let's understand what FRA in the simplest way possible. FRA is called forward rate agreement. It is like, it is like a deal that you make today, right, to lock in interest rate for a loan or deposit that is start in the future. So basically what you do, you lock in the interest rate, right, for the loan or deposit that will start in the future. It's like saying, let's fix the interest rate now. I don't have to worry about the future changes. Now what is option A? So it is wrong. It is a stock trading contract executed on a stock exchange. This is wrong because FRA has nothing to do with, stock or exchange. It is an interest rate product. Remember, FRA is nothing. It has nothing to do with stock. It is a kind of interest rate product. Okay. What about option B? It is a contract to buy or sell foreign exchange at future date at fixed rate. No, this is forward FX contract, forward exchange contract, foreign exchange contract, right? Not a FRA. FRA deal with interest rate, not currency. Here the point is currency. Option C. It is an over the counter contract where party agree today on interest rate. Yes, this is the correct. It is a kind of private contract, OTC contract, where the two party agree today what the interest rate will be for a loan or deposit that is start in the future, customizable one. Option C is the correct one. Option D, it allows party to exchange fixed interest payment. That is wrong. That describes the IRS interest rate swap, not FRA. Let me give you a real world example. Imagine you are a company that need to borrow 10 crore rupees after 3 months. So you need to borrow 10 crore rupees after 3 months. Okay. You are worried that interest rate might goes up by then. So what you do to protect yourself, you enter into FRA today. So you enter into FRA today and fix the rate at 6% for that future borrowing. Now even if the actual market rate becomes 7%, what will happen? The FRA ensure that you effectively pay 6% only, saving your interest cost. So what we learned is that FRA, so let's summarize the key point which we have just discussed now about FRA. So first point is that FRA, FRA is a kind of OTC product. Okay, it fixed the future interest rate. It is used for hedging. And speculation. And underlying thing is the interest rate here. It is commonly used to lock a loan deposit rate in advance. Friends, we have several more questions available here as you can see. If you want me to explain all the remaining questions, you can write yes in the comment section. I will understand that yes, you are interested in the remaining question. Now let's end our video with clear summarization of all the concepts which we have learned today. So the first concept I told you about, coupon. What is the coupon? Coupon means it is giving you fixed percentage on the face value. And this coupon yield is a kind of return. How do we find the coupon yield? What you will do? You will write coupon in the numerator. You write price that you have actually paid in the denominator and multiply it by 100 to get in percentage. So that will give you coupon yield. And remember, if you are buying larger than coupon, if your buying price is larger than the face value, your coupon yield will decrease. Okay, these are the 4 points which we have discussed. Now in the next question, what we discussed about front office, middle office and back office. I told you that this front office are the action. They are the deal maker. They trade, they manage the risk and manage liquidity. Middle office, you can think of them like monitoring. They are the controller. They report, they monitor and they maintain the risk. And then we have the back office. They are like administration. They execute, they confirm, they settle, they record. So remember, these are the key functions of these 3 office. Questions are most frequently asked. In the next question, we discuss about Greeks. I told you, Greek is a kind of risk indicator. There are several factors which determine the option value like time, price, volatility, interest rate. So all of these factors determine the option value. Delta, rho, gamma, theta, vega. These are, different kinds of Greeks. Then we talk about AGL, aggregate gap limit. So what is AGL? So AGL shows the total allowed currency mismatch. And RBI fixed the AGL at 6 times the total capital and affects foreign exchange risk management over the time. It helps in foreign exchange risk management over the time. So remember, total allowed currency